I take an immense pleasure in welcoming respected CA Dhananjay Gokhale, who has an amazing 25 years of experience as a practicing chartered accountant. Being a commerce graduate from University of Mumbai, he's a founder and partner of Dhananjay J. Gokhale & Co., which specializes in providing management consultancy services, auditing and assurance services in corporate and banking sector. His years of experience makes his contribution to the area of bank audit really very apparent. He has been a co-opted member of AASB of ICAI for the financial year 2018 to 2019. He is now the deputy convener of the study group formed for ICAI Guidance Note on Audit of Banks 2022 edition. He was a member of expert panel constituted by AASB of ICAI for addressing the bank audit queries of the members for the period 2011 to 2012. He has authored ICAI Guidance Note on Audit of Banks for 2016 to 2022 editions. He penned on various other articles published in ICAI magazines specializing in bank audit. He has handled a variety of assignments related to arena of bank audits, including statutory central audit of PSBs, merger and acquisition of urban cooperative banks, and consultant to board of banks. He, being an active speaker, has made his presence here, and we are very glad to welcome CA Dhananjay Gokhale once again. Thank you, sir. We invite CA Dhananjay Gokhale to share his views on the topic.
Good afternoon to all of you, and thank you to the entire management committee of Madurai branch for inviting me over here. Especially Madam who who had interacted with me a lot, and there was a slight delay from my side also to send the material. So my apologies for that. The reason was that I wanted to make a presentation on loans and advances in a little non-traditional way. So I divided my presentation into two parts. The first part is not at all related to LFAR. It is more related from balance sheet angle as to how the balance sheet presentation is there, and we'll talk more about in general about loans and advances. And in the second part, that is post-lunch, we'll talk specifically about what we need to report in LFAR. So I just thought that I will divide it into two different parts altogether, which are different from the traditional one. I will not touch upon much in IRAC norms because Ramesh sir has already spoken a lot about that. But wherever reference Advances. If you have any doubts in between, you can interrupt me in between the session also. That is absolutely fine. Even if that is not related to advances, even that is fine. That's not an issue. I will just spend 2 minutes before I start off with the topic, and I just wanted to touch upon certain things related to bank branch aspect from bank audit guidance note point of view. Ramesh sir has also touched upon bank audit guidance note. I happen to be associated with bank audit guidance note for almost last 7 to 8 years. For last 3 years, I have been working there as a convener and deputy convener. Only one suggestion to all of you for next year, because last year guidance note is already there, so I cannot suggest about last year. Whenever the draft gets published for public opinion, make it a habit to go through that. In whichever area is you feel that you are interested in, just open up that chapter, go through that chapter, and give suggestions to CA Institute. The reason being, every year the guidance note keeps on improving. RBI circulars are added in the guidance note, and at the same time, there is something which is beyond RBI circulars, especially about the interpretation of circulars, or at certain cases we have institutes opinions also which are given indirectly in the guidance note. So it's not that the same thing gets repeated. And just to add a little highlight about that, how the guidance note is really worked out is, all the chapters are there which you see as the index in guidance note. For every chapter, there is at least one writer and one reviewer. So the earlier years Word document is given to the writer. He keeps on doing the changes in that. That is again reviewed by the reviewer. Ultimately, the convener also reviews the entire guidance note, and then it is published for public opinion. And it is kept open for everyone. So RBI, banks, auditors, anyone can react on that. Your every suggestion is taken up at the institute level, and there is a justification which the writer, reviewer, and convener has to give for any comment or any question or any query which you are raising on that bank audit guidance note. So there is nothing like your query gets ignored, or it is not getting passed on to the highest level. Every query gets answered. Wherever changes are required, the changes are also made, and then the final bank audit guidance note is taken out and published. I just thought that I will just spend a couple of minutes on the bank audit guidance note, so that next year you can think about it of going through the guidance note and giving suggestions, because ultimately it's institute's publication. As all of you you are well aware about, it's a kind of honorary job wherein every CS contribute to that particular part. So you can also become a contributor for that. Now, talking about today's topic about loans and advances, I wanted to cover the aspect in these 5 to 6 parts. First is about balance sheet disclosures. Then I wanted to talk a little bit about types of advances which we generally see. Then there are certain commonly used terminologies are there, which might be kind of a refresher kind of a thing for all of you. But I just thought that to just touch upon those. We'll talk a little about appraisal part, documentation part, and a little bit about monitoring of advances. IRAC norms, as I said, that I will just touch upon that. I won't get into detail into that. So let's start with the balance sheet disclosure. Now, typically what really happens is, as far as bank branch auditors are concerned, we typically ignore as to what is really getting presented in the balance sheets. We are only concerned about the trial balance which is given to you. And there is one hitch in what we certify at the branch level. Even though as a branch auditor, we are giving opinion about true and fair view, even though we are saying that that is about financial statement in certain banks, in reality, we don't even give any opinion on true and fair view of the financial statements. The reason being, at the branch level, what you really give opinion is only about GL level summary or a trial balance. It is not a full-fledged financial statement. We don't go through the notes on accounts also, because that is not our job. So as a bank branch auditor, there is a limitation on that. At the same time, as a branch auditor, we need to understand that ultimately whatever GL balances which we are going to give opinion about, how they get presented in the bank's final financial statements. So the reason why I just thought to just reproduce the chart about disclosure is that it might happen that otherwise the account is standard, documentation you have verified, but maybe classification of that advances might not be correct. So the GL level where that the SL level balances are getting percolated or combined or aggregated, that might be wrong, and you might require to pass a MOC related to that. So this is schedule 9 of form A, which I've just reproduced. There is no change which has been made in this third schedule of BR Act.
Since years it has been same. So here we have a division between bills purchased and discounted, CCOD accounts and term loan accounts. So these are the three basic bifurcations within the account. Then further we have a bifurcation in an entirely different way, secured by tangible assets, covered by bank or government guarantees, and unsecured loan. So this is again a disclosure. Then another one is that we have bifurcation between advances in India and advances outside India. So within advances in India, we have bifurcation between public sector, priority sector, banks and others. As far as advances outside India are concerned, the bifurcation is due from banks, due from others. Within due from others, we have three bifurcations. Now, let me just, before we go with types of advances, or rather, parallelly, let me just draw certain parallels by giving a couple of examples about how the products are now combined by the banks. So even if you look at a particular product, it might appear to be a different product as far as disclosure is concerned, but as far as behavior of the product is concerned, it might be entirely different. Now, typically when we talk about types of advances, under term loans, we typically have personal loans, gold loan, advance against securities, housing loan, other term loans. So I've just broadly classified that. As far as working capital finances are concerned, typically there will be three classifications. One is cash credit, second one is overdraft, and third one is WCDL or WCTL. The nomenclatures are varied within the banks. As far as the non-funded portion is concerned, we typically have BGs, LCs, and letter of comforts. Now let me give you a classic example as to how the nomenclature might be different from the actual behavior. And since it's a closed forum, I can give, maybe I can quote indirectly a bank's name. There is a housing loan scheme which is launched by one of the largest public sector bank, wherein there is a concept of drop line OD which is provided along with housing loan. So whenever a borrower avails a housing loan, what he actually gets is not a term loan, he gets a drop line OD. Now how you can substantiate that is, in case of that drop line OD, there is a checkbook facility which is provided to that particular customer. So on one hand, we have it calling it as a housing loan. On the other hand, it practically is a overdraft limit. Unfortunately, in that bank, there is another kind of goof up which is made, that on one hand, the type of loan is considered as housing loan. So typically, presumably, it is a term loan, but which is not the term loan because the OD facility is given. There is a checkbook which has been provided. Now, as far as the NPA norms are concerned, there is a challenge in applying NPA norms to such loan accounts. If you apply NPA norms related to said term loan, let me just give you a hypothetical example. Let's presume that you have a particular facility given for say 15 years. So there is a borrower who has come to you. You have sanctioned him a facility of housing loan for 15 years under that particular scheme. Let's presume that the loan which is taken is say 15 lakhs. So let's presume that every month 15,000 is the installment by normal traditional term loan methodology. So in term loan, what we do is that there is we calculate the overdue portion of term loan. So we compare the ideal DP, we compare with the ledger balance. If your ideal DP is less than your ledger balance, there is a portion of overdue which you will quantify. You will divide it by EMI of that 15,000. If it is more than 3, you will say that it is outstanding or overdue for more than 90 days. You will mark that as an NPA. Now let's presume that it is a drop line OD. So drop line OD means suppose you have given say 15 lakh rupees as a loan, 15 lakh divided by say 180. So that to that extent your OD limit will get reduced. So over the period, your OD limit from 15 lakhs at the end of 15 years, it will reach to a portion of 0. So that's the concept of OD which all of us are aware about. That's a drop line OD concept. And drop line OD concept, what you really have to look at it, you need to apply the norms of out of order status. So the first norm of out of order status is that whether the account is continuously overdrawn for more than 90 days. And drop line OD, based on the reduction in OD at the end of every month, you need to apply that logic. Now let's take a second example. Let's presume that a borrower has prepaid certain installments. So by normal term loan concept, your ledger balance will be always lower than your ideal DP. So maybe suppose someone has prepaid the installments in the month of April itself, say 12 installments are prepaid. So practically by till March end, that account will never turn into NPA because the installments are already funded. So your ideal DP will be always greater than your ledger balance. So there is no overdue. So in term loan, there is no issue. Now let's compare this with the OD concept. In OD, what will happen is the account is within limit because you have prepaid that. but the interest and credit summation matching and not having credit in last 90 days, these two conditions, the last two conditions of out of order status will never get fulfilled, because the account will appear to be within limit, but there is no matching of the interest which are debited to the account in last 90 days compared with credit summation. That will not happen, and the account will technically turn into an NPA account. Now what that bank has done, now this is I'm saying about almost 2 years back, because after that my bank got changed, so I couldn't again compare that. But what I believe is that the last year also the same thing was there. What the bank has done, as far as classification and other things are concerned, they are applying term loan category. As far as working is concerned, they are classifying it under OD category, because otherwise checkbook cannot be issued. So you have to choose a product code. So the product code chosen is OD, but the NPA code which is chosen is related to term loan. So this is something which is which is not done. You cannot have best of both the sides. So these things do happen. So pay attention to what kind of GL head the bank is choosing. Compare that whether the same logic is applied to the NPA category classification or not, because both things should gel with each other. And then look at the presentation aspect as to how that particular entry or that particular ledger will get presented in final balance sheet. Even if you are a branch auditor, you have every right to ask the branch as to a particular loan account where it gets classified in the balance sheet, because your tagging of every loan is important, and there might be a systemic issue as far as the bank is concerned, and as a branch auditor you can very well point it out, which will affect the bank as a whole in a larger way. So I just thought to draw certain inferences instead of just sticking to the theory. So I'm just deviating a little. I hope that that it's fine with all of you. Now, as far as certain commonly used terminologies are concerned, we'll just run through one by one. The demand loan, which all of us are aware about. See, what is really mean by demand loan is that demand loan is such kind of a facility wherein that entire facility can be called back by the bank. The bank has right to call back that entire facility at any given point of time. So typically, just to give an example as a corollary, term loan will never be called as a demand loan. The reason being, there is an installment which is committed by the bank, or rather which is prescribed by the bank. So there is nothing like demand which can be created by the bank on a particular day. Second and third terminology is bills purchased and bill discounted. As far as the Indian banking industry is concerned, sure, yeah, CCOD account, you can call back at any point of time. It's payable on demand. So if you look at the DP note, typically you will see those wordings. So that's the example. And term loan, that should not be the case, because term loan is staggered. There is a committed kind of a staggering. As far as bill purchase and bill discounting is concerned, practically in Indian banking scenario, both terminologies are used by the bank in a very synonymous way. So there is not much of a change. There are few banks which distinguish between that, wherein they classify LCBD as bill discounting, and they say that clean discounting of bill is bill purchase. But practically, as far as classification or as far as IRAC norms are concerned, both are same, except that whenever bill discounting is backed by LC, the exposure is always on the bank, who is issuing the LC, and the exposure is not presumed to be on the borrower. So that is the only distinctive factor. Funded credit facilities, just to give an example, as far as any credit facility is concerned, wherein the funds of the banks are given to the borrower or on the instruction of the borrower are paid to someone else, then that becomes a funded facility. As a corollary of that, non-funded facilities are those wherein the bank is committing to make a payment on happening of a certain event. Now, in case of bank guarantee, the event will be predefined in the bank guarantee. As far as LC is concerned, typically it is a commercial transaction wherein the entire process flow is defined. The which kind of document should be submitted is also defined. So LCBGs are the typical instances of non-funded based facilities. Letter of comfort, I think after PNB, everyone is well aware about buyer's credit and letter of comfort. I don't have to really explain that concept. The simple concept is everything related to non-fund based facilities are wherein the bank is yet to part away with those funds. It is only commitment to pay the funds, or it is a kind of a guarantee which is provided by the bank. So the moment any LC or BG gets devolved, the non-fund based facility gets converted into a funded facility. So till that time, it remains as a non-funded facility. Then the next terminology is primary and collateral security. Primary securities are those on the basis of which, or on the strength of which, the borrowing limits are sanctioned. and secondary securities or collateral securities are those which is a kind of a fallback arrangement for the bank. But as far as collateral securities are concerned, that will not affect the drawing power of any of the borrower account. So typically, just to give an example or how it affects the balance sheet presentation is, let's presume we'll take example of two loans. In one loan, the primary security is say stocks, that is equity shares, and against the strength of equity share, the loan has been granted. So wherever the security price is fluctuating, maybe presuming that it is a OD limit against equity shares, your OD limit will also keep on fluctuating. So that is one example. Second example is that equity shares are given, but they are given as a collateral security, and a primary security is might be say immovable property, but still there is a collateral security is taken. Now in the first instance, that particular loan will be considered as exposure to equity. The reason being primary security is taken as is in the form of equity shares. In the second case, it is not an exposure to equity shares or it is not exposure to share market. The reason being it is a collateral security. Secondly, the fluctuation in value of collateral security per se will not affect your loan account, in the sense the borrowing limits. So that's the bifurcation between or distinctive factor between primary and collateral security. Just to add over here, as far as security is concerned, how it affects your classification of advances. So as far as secured loan and unsecured loans are concerned, secured loans are those in which at the time of sanction of the loan, if your security which is available is more than 10% of your sanctioned limit, then it is called a secured loan. Now when you calculate that 10%, it will include both primary as well as collateral. So that's how you have to make use of primary and collateral security valuation. So that is one instance. Second instance is that there is a straightaway classification norm which Ramesh sir has already touched upon. So I will just reiterate that whenever you are calculating that deterioration in value, there are two instances wherein straightaway classification norms are there, wherein you don't have to wait for 90 days delinquencies. So first is that wherever there is a deterioration in value beyond 50% as compared to the earlier valuation, your account will turn into a doubtful asset category. Second is that in case of secured loan, if your security value is less than 10% of your ledger outstanding balance, it turns into an NP account. Now there security value includes both because you have the backing of both the things. But as far as exposure norms are concerned, you need to be concerned only about primary security. Collateral security is redundant in those cases. Only thing is that wherever there is a shortfall in primary security, let's take a case that there is a shortfall of primary security, then in that case you can take a support of collateral security to ensure that the loan is secured. But drawing power calculation will be never based on collateral security. It will be always based on primary security. So in certain cases, you might observe that the branch manager might start arguing with you that suppose there is a shortfall of drawing power based on stock statement. He might say that I am having a collateral security which is worth say four times of your sanction limit. It doesn't make any difference. It only makes that classification of advance as a secured loan. Nothing beyond that. There is no benefit of collateral security which is available. One more interesting case is that let's take a case wherein a branch manager is arguing with you that there is a shortfall of your drawing power because of maybe not having sufficient DP, not having sufficient working capital gap. So if the branch manager at that point of time, if he mixes of collateral and primary security by changing the terms of the sanction letter, it happens that suppose you are having a shortfall of DP, he will say that there is a new sanction letter which we are issuing, wherein now the collateral security will be also considered as a primary security. So the collateral security which is in the form of immovable property, that is added up for the calculation of DP. This is a clear-cut case of restructuring of advance, or you can say evergreening of advance. So at the time of such conversion or change of terms, firstly the account should be within the limit based on original terms and conditions. And then they can add up or then they can swap, that collateral can be added in primary, because then there is no accommodation which is done on the date of sanction. So you need to be very careful wherever the collateral security is changing the nature into a primary security to check up whether there is an attempt of evergreening which is done by the bank or not. If you are certain that there is a sufficiency of security which is available, and then for enhancement someone is adding up that particular security which is a collateral security into a primary security, it doesn't matter because it is a business call. You don't have to really challenge any credit call of the bank. Since I was talking about challenging the credit call of the bank, even though we will be covering that in the post-lunch session about LFAR, the new LFAR has one peculiar case wherein the statutory auditor can comment upon lacunas in credit appraisal of credit appraisal. that is something wherein indirectly you are in a position now to challenge the credit appraisal process in a very delicate way. Why I'm saying delicate way is that you cannot challenge the credit call. You can challenge the credit appraisal process. So there is a finer difference between two. Credit call is something which is a business call. As to whom the loan should be sanctioned is a call of the bank. You cannot challenge it. If there are lacunas in appraisal, you can challenge it. That's why I said that indirectly you can challenge. Directly you are not supposed to challenge. Then the next one is personal guarantee of the borrower and guarantor. Now, as far as personal guarantee of the borrower and guarantor is concerned, it is of no use as far as security is concerned. In the sense, you cannot say that a loan is secured loan because there is a guarantee of personal guarantee is given, or the guarantor is having a huge net worth. That net worth and everything is of no use unless it has been offered as a security to the bank. Otherwise, it's of practically no use. Let me just add one point over here. Even though this is not really material from scheduled commercial bank point of view, I'm not sure if any one of you is doing urban cooperative bank audit. I'll just add one deviating factor which is there in circular of IRAC norms and management of advances for UCBs. Just for knowledge sake, I'm adding. There what they have defined is, in case if you have obtained a commitment, which is various state laws are having different sections. So in Maharashtra we have section 49. Section 49 is, empowers the bank to directly recover the salary from employer. It's a kind of a format also which one has to submit. In IRAC norms of UCB, it is defined that if such form is obtained, that loan is treated as a secured loan. So that's a kind of a deviation actually. I just thought that I will just add as for your academic interest, but that is not applicable for scheduled commercial bank. So as far as all of us are concerned, for public sector bank audit or scheduled commercial bank audit, it is of no use. UCBC, if any one of you is doing that, just pay attention to that particular factor, because otherwise the classification and disclosure might go wrong, because you need to define between secured and unsecured portion, as we discussed earlier. Then as far as fixed charge and floating charge is concerned, let me just give you an example. Fixed charge example is that suppose you have taken a primary security of immovable property, that is a fixed charge. It is not going to change. Floating charge is something wherein you create a charge on overall assets, but the nature, quantity, value, everything keeps on changing. For example, if you create a charge on say book dates and stock, that is a classic example of floating charge, because it will keep on changing. Typically what the banks do, they create a floating charge on current assets. So almost everything gets covered. So whatever is there under current asset, that is charged indirectly to the bank. So that is the example of floating charge. Margin, the concept all of you are aware about. Typically margin word is used whenever for calculation of DP, or whenever for calculation of maximum permissible bank finance. The credit policy of the bank will define that as far as the securities are concerned, how much margin bank should keep and give the loan against that. So bank might be having a policy for say OD against property, wherein the margin kept is say 50%. It means that whatever valuation is done for that particular immovable property, suppose it is say 50 lakhs, and the bank's credit policy defines that 50% margin is mandatory. It means that against 50 lakhs, you can avail a maximum permissible loan up to the extent of 25 lakhs. Similarly, for CC facilities, typically the margins will be defined for different types of securities. So some banks have a policy wherein for stock, suppose say the margin is say 25%, and let's presume that say for book dates, they might define differential margins also. So maybe for 0 to 60, they might have 25%, 60 to 90, they might have, say 40%. So depending upon the bank's policy, depending upon the bank's terms of sanction, the margin limits will be defined. Since we are talking about DP, let me just talk a little about that, even though, we might again touch upon that. As far as DP calculations are concerned, there are various, you can say, arguments which are done by the auditors as well as by the bankers. So let me just touch upon that. Is it fine for all of you if I deviate a little than what I'm presenting? I just wanted to touch upon the practical aspect rather than sticking to the theoretical part. So as far as DP is concerned, the common issue or a common argument which is done by the bankers or many bankers is that the trade creditor should not be reduced, or trade creditor should be reduced only to the extent of they are exceeding the CMA level which the borrower has submitted. Now all these arguments is a myth. As an auditor, you are not supposed to even listen to these arguments, because the working capital finance itself means that there has to be a working capital gap, and then you have to reduce the margin, and then the drawing power has to be calculated. Now let me just draw a parallel of that, and I will go step ahead. There is a RBI circular, I think dated 94 or 96, because that circular is not available on RBI website, but the circular is very much there, which talks about that CMA above level creditors. So the circular says that, but we need to interpret that circular logically. What RBI had expected at that point of time was that the CMA level of debtors as well as stock will also be maintained. You cannot have a scenario wherein CMA level book debts and stock will not be maintained. It might be on the lower side, but on the other side, you need to ensure that CMA level creditors should be compared with. So that will become a kind of uncomparable thing. What you need to go by is, if you go with any committee reports, I don't even want to name any committee report, because the committee reports are only confined to give a guidance to the bank. If you look at the credit policy of any bank, the bank credit policy will define that how to calculate maximum permissible bank finance. Further, they will say how to calculate drawing power. So the standard formula for calculation of DP is that you need to take up the debtors up to the permissible age, which might vary from customer to customer or from bank to bank. So someone will say up to 90, someone will say up to 120. That is fine, because that is up to the banks and to decide that. Once we do that, plus stock, which will exclude the slow moving and non-moving stock, reduced by trade creditors. Whatever remains after that, you need to reduce the margin. So suppose you have a scenario wherein say stock is 100 and say creditors are 150, that negative figure has to be knocked off against your book debts also. And for trade creditors, there is no upper cap of age limit. Entire trade creditors has to be reduced. There is nothing like up to 120 days or up to 190 days of creditors which should be reduced. So if you don't have sufficient DP, you can surely apply the norms of out of order status using these normal formulas. And even if the bank is arguing anything like only the portion of creditors which are above the CMA level creditors should be reduced, that is something which is illogical. The simple way to address this particular issue is that ask the branch manager to give you a representation in writing, quoting an example wherein working capital might be negative. Because you can have a working capital negative status also, wherein the trade creditors are below CMA level. But on an overall basis, if you add up book debt stock and reduce by trade creditors, there might be a negative figure also. Bank is not supposed to finance negative working capital. So that's where issue will typically get resolved. So don't get under any pressure or any RBI circular. There is nothing of that sort which is expected from RBI's angle also. Follow the normal simple accounting logic that working capital finance means firstly I need to have working capital gap. Otherwise, the borrower is not supposed to even take working capital finance because there is a negative working capital. So then working capital funding itself is not required because the creditors are funding him. So the bank is not supposed to be there in picture. You automatically get funded, that too without interest. So you don't have to really bother to get funding from the bank along with interest. Another typical wordings which are used is sole banking, consortium banking, multiple banking. So let me just distinguish between that. As far as sole banking arrangements are concerned, the funders to the borrower remains with a particular bank only. There are no there is only one bank which will be there as far as funding is concerned. He might have parallel banking activities which are done. That is not the topic of discussion. But the funder bank should be only one. That is sole banking. Consortium arrangement is the one wherein all the funders will come together and they will provide the banking funding facilities to the particular borrower. Multiple banking runs in a parallel way. So every bank has its own course of action. They might have different kind of securities which are taken by individual bank. They might have first charge, second charge concept, wherein they might exchange the remaining portion of security with the other bank. Now, in case of multiple banking arrangement, everything runs parallelly. There is no common agreement which is done, unlike in consortium advances, wherein there is a common agreement which exists. Now, the challenges in multiple banking is that typically in multiple banking, there is no bank which acts as a leader. So there is no consortium leader. Everyone is a leader. So everyone will go in a different way. Everyone will might have a different kind of calculation of DP, calculation of maximum permissible bank finance, and everything can run parallelly. Now, what we need to check it out as a compliance part is, in case if you come across a borrower who is having a multiple banking facility or a consortium banking facility, and if the exposure is above 5 crore, there is a RBI circular which mandates for diligence reporting. So diligence report is a specific format which RBI has prescribed, and the diligence reporting can be done by a CA or a company secretary, either of them. wherever there is an exposure beyond 5 crores, wherein more than one bank is involved. So just ensure that the diligence report is available on the record. If the diligence report is not available on the record, you are required to report that in LFAR. There is a specific clause in LFAR. Only unfortunate part is that in LFAR, RBI has done a typing mistake wherein due diligence report is written. There is nothing like due diligence report. The report is called as diligence report. Due word should be ideally should have been dropped. But anyway, that's a typing mistake from regulator side. We cannot challenge that, but that's the reality. RBI circular is about diligence reporting. Then as far as loan syndication is concerned, it is a typical case wherein one of the banker will act as a kind of service provider to the borrower. So for example, suppose there is a large borrower industry who approaches a bank and asks the bank to arrange for funding of say 500 crores. Now suppose the bank is not in a position to arrange for that, bank might syndicate the loan. So they might scout for different consortium members, or maybe even different multiple bankers also, and they will provide a professional service to that particular borrower wherein the loan syndication is done, and there is a syndication fee which is separately charged by those banks. So it's a kind of a para banking activity in a way, wherein similar to any professionals, the bank will act as a professional and they will make a loan syndication on behalf of the bank. There are banks which do loan syndication which also includes issuance of securities also. So you might have read certain advertisements in newspaper that loan syndication was done by so and so bank, and there was an issue of bonds of say 500 crores which was done for a particular company. So the issue is also managed by the bank, and that also is covered under the syndication concept. Which one? Okay. If they are doing underwriting, then that has to be shown. Otherwise not. Otherwise, they are purely providing the service. What you need to ensure is that how the income accounting is done by the bank. There has to be a certainty of income. So unless the work gets over, you are not supposed to book the income. There is an agreement actually. There is a loan syndication agreement which is entered. It includes roles and responsibilities of both the borrower as well as by the bank. There is a payment structure also which is defined, which is very similar to what we can do with any of our client. Yeah. No, they take directly from the borrower. It's a kind of arrangement actually. It's a combined arrangement. Yeah. Typically from other banks, the banks don't take any fee because it's kind of a sharing of your risk which is done. They directly take it from the borrower. They get business. No, there is nothing like referral fee which the banks are taking. At least I won't come across that. But there is no bar as such because it is between the bank. Typically what they do is, even in consortium, the consortium leader typically collects the entire fees. They keep a larger portion of that, which is not in equal proportion of the loan which is taken. So there is a kind of additional fee which gets retained by the leader. So same logic gets applied over here, but it's agreed upon terms. So there is nothing like ambiguity or uncertainty. Income leakage, yeah. Yeah, you have to go through the agreement actually, because each agreement will be unique. It will depend upon which kind of terms have been agreed upon. So in fact, if someone has agreed upon to pay from borrower side, he need to say that as a contingent liability. From the other side, whoever is the payer, receiver cannot obviously recognize it. Then another concept is interbank participation certificate. Now, typically, if you ask me about interbank participation certificates, the most common thing is I thought that someone is asking query, so I just paused for a while. Okay, as far as interbank participation certificate is concerned, there are two types of certificates. One is wherein the risk sharing concept is there, and second one is on the risk sharing basis. Now, how does that distinguish it between that? So, as far as interbank participation certificates are concerned, let me just give you a simple example. For example, all the banks are having priority sector targets. So suppose a bank is not able to fulfill that priority sector target, it can ask the other bank which is having sufficiently large portfolio of priority sector sector portfolio and they can participate into that. Now, based on the risk sharing, whether the risk of realization is shared by the bank, which bank is sharing that risk, based on that, the charges for that interbank participation certificates are defined. So I will just give you an example. Suppose I am a bank which is running short of priority sector advances. I don't want to take any risk. So I can simply purchase this interbank participation certificate from the other bank without sharing any risk. So there is a charge which I will pay to that bank for the simple reason because they are having surplus of priority sector advances and they are sharing that with me. So it can be with or without risk sharing. Both options are available. The maximum usage or the typical use is wherever you are not able to meet that sectorial caps. That's the point wherein you can do that. Second thing is that if you are exceeding any exposure caps, you can sell off your portfolio by using this methodology instead of actually selling off the entire portfolio. There are two ways to deal with that. One is that you can sell your advances portfolio to the other bank. Second is interbank participation certificates wherein the portfolio remains with you. You are only parting away with certain portion of that, fulfilling your sectorial caps, either you're wherever you're exceeding or wherever you're running short of those caps. So that's where this will come into play. Now let's look at certain aspects related to appraisal of advances. Even though those parts we will again touch upon in LFAR, but the majority portion we can touch upon right now. As far as appraisal is concerned, whenever you are going through any loan file or whenever any borrower files you are reviewing, just couple of things as a suggestion. See, wherever you are preparing yourself for your firm for statutory audit or even for concurrent audit also, make it a habit to have a checklist for each type of loan. So once you have a checklist for each type of loan, any person from your firm, whether he's a partner or he's a first year article, if any loan is checked, that entire checklist has to be thoroughly filled up, or you can say ticked by that particular person who is going through that loan. So when I'm talking about appraisal part, the best part is that for each product of the bank or each product which is available at a particular branch, it's better to have a checklist for that product so that you don't miss out on any aspect related to that. Now, typically what we all of us are going through is that first thing is that you need to go verify the application form. When you are verifying application form, you need to verify whether the correct application form is filled up or not. In the sense, there will be multiple application forms for different products. You need to see that the product which the borrower has availed and the application form which the borrower has given is gelling with each other or not. You cannot use different products application form for another product. Secondly, the application form has to be filled up in entirety and it has to be signed also by the borrower as well as guarantors. If it is not signed, practically it's as good as not obtaining an application form. Another typical issue in case of statutory audit and even for concurrent audit is that the moment you say that it is not signed, the branch manager will rush to the borrower, he will obtain his signature and do all kind of compliances thing. The best way to deal with that is you just start sending emails of all the discrepancies which you are observing in any loan file. So that will give a sufficient kind of documentation with you, and that will be a kind of tricky scenario for the branch manager because everything is now in writing. So he cannot deny that also unless he responds back. So what we do as a firm, I will tell you, at the end of the day, typically we send all the queries to the branch manager and we say that if any of the queries, if you are not agreeing upon any query, you are supposed to respond back to us immediately. If it doesn't respond back to us, our job is done because then the entire story is available for you to incorporate in LFAR. Now, other documents which are ideally should be received with the application are there. First one is that the financial statements of borrowers and guarantor has to be received. And as a CA, you need to logically look at that. Why I'm saying logically, I will give you an example. I have seen certain files wherein the borrower or guarantors, they have filed presumptive basis return. Still the banks had taken the entire financial statements and everything was taken. Now there might not be any sanctity to such financial statement because in the income tax return, someone says that he is not maintaining proper books of accounts. On the other side, the entire financial statements are available. So just look at the sanctity of that. Look at the correlation of financial statement with income tax return which he has filed. If they are matching, it's fine. It doesn't make much of a difference. But both things should match with each other. Then there will be financial projections which might be given by the borrower. Now, when you are looking at financial projections, just look at it that whether the financial projections are achievable and logical or not. Suppose in first year or in year 0, that is the present year, if someone is having a turnover of 10 crore, in the next year, if he's saying that now it is going to be 50 crores, there has to be a justification available for that. So if there is a organic normal growth is there, you don't have to really get bothered about, because there will be a legacy of growth. Every year 5%, 10%, gradually the business is growing. If there is a massive jump or sudden jump, there has to be a reason for justifying for that jump, and there has to be underlying document which should be also available in the file. Then many banks are having a threshold limit wherein they specify that if the exposure is above a threshold limit, there has to be a techno-economic viability study which should have been conducted for that particular industry or for that particular borrower. So go through the credit policy of the bank, understand that what is the threshold limit which is kept by the bank, wherein the techno-economic viability study is made mandatory. Then as far as the associate concerns are concerned, typically most of the banks are having a column of listing down the associate concern. Just verify that with the financial statement as to whether all the related parties are included in the associate concern list or not, and vice versa, that whatever is disclosed is the same list which is there with the related parties. Then as far as primary and collateral securities are concerned, typically the documents which you need to see is there has to be ideally a title clearance report, there has to be a valuation report. Now as far as valuation report is concerned, the mandatory part about valuation report is limited only to the extent of NPA accounts which are having exposures above 5 crores. PA accounts which are below 5 crores, once in 3 years is not a mandatory norm. It might be a suggestive norm, or it might be incorporated in the credit policy of the bank, but it is not mandated by RBI policy or RBI regulatory norms. So whenever we are writing a query about the last valuation report was beyond 3 years, always make it a habit to draw the inference about your query. So suppose a particular bank is having a credit policy wherein it defines that for every loan there has to be a valuation which is carried out once in 3 years. Draw inference from that by saying that credit policy clause number so and so requires to carry out the valuation once in 3 years, and then write down your query. Don't simply correlate that with RBI norms, because RBI norms are only related to NPA accounts, not related to PA accounts. So for PA accounts, there is no RBI norm which mandates your valuation which is required to be carried out once in 3 years. Second thing is that many banks have a threshold wherein up to a certain level the valuation is carried out by a single valuator. Beyond a particular level, they might mandate more than one valuation. So maybe a bank might say that up to 10 crores, we will have only one valuer. About 10 crores, we need to have at least two valuers. They might have deviation norms also. That suppose the deviation between two valuation is beyond say 10% or 20%, there might be a third valuer which might be roped in. So go through the policy of the bank as to how it is mandating the valuation aspect to be covered. As far as title report is concerned, just look at the title reports, especially in case of NPA accounts. And wherever you find out that there are NPA accounts wherein there is an issue related to title, and maybe that is getting reflected in valuation report also, you can very well make it as a point in your LFAR by saying that the title report was given clean and subsequently there are certain delinquencies which have been found out. As far as companies are concerned or even partnership firms are concerned, you might be requiring to obtain board resolution or partners resolution wherein the loan is applied, so that you come to know that everyone, the entire management is agreeing upon the loan application or not. As far as requisite licenses are concerned, practically as a CA, you cannot really know that how many laws are really are applicable to a particular concern. But whatever the general knowledge we are having, we can have certain basic registrations which can be obtained and which can be seen. Typically, what we can see is the basic statute which we need to go through, that is article and memorandum of association. If it is a LLP agreement will be there. Partnership firm, partnership agreement will be there. GST registration certificate will be there. If you are having profession tax in a particular state, profession tax registration certificate will be there. If it is a factory, then factory license will be there. If it is a particular industry wherein pollution board certification is required, that has to be there on record. So any certificate which according to your knowledge is essential to run that particular business should be available on record. We don't have to really do a Google search to understand that how many registrations are required. That is not really within our scope. Whatever we are aware about, we can apply our knowledge for that borrower file and we can verify that. Second thing is that whichever certificates which the borrower has submitted, especially pollution board certificate, just look at one point that whether it is valid today or not. It might be the case wherein the certificate is already expired and he is just giving you the certificate for the sake of that. So that is something which shouldn't be the case. Few other things are like KYC compliances. Now typically KYC is the word which we use related to deposit side. That is equally mandatory for borrowers also. So for borrowers, just look at the aspect as to whether the KYC is compliant with respect to borrower as well as the guarantor. So you need to ensure that both borrower as well as guarantors KYC documents are available in place. MSME registration certificate needs to be checked wherever a bank is classifying a particular account under MSME category. There are benefits of MSME category in multiple ways. One is the MSME relief which RBI has given for last few years. Second thing is that there are banks which are giving concessional rates for MSME borrowers. And third thing is that as far as MSME registration certificates are concerned, MSME registration certificate per se is not mandatory. One can just have a declaration, one can just produce a financial statement and they can say that they are falling under MSME. But to verify MSME certificate is the easy thing for the bank as well as for the auditors to understand that whether a particular borrower is falling under MSME category or not. Yeah. There are banks which are having special schemes to fund such accounts. No, that will be always PA. So I will give you an example again without quoting the bank. There are schemes which have been launched by certain banks wherein the scheme itself is for NP accounts. So their intention is clear that they are funding to NP accounts. So what they do actually, they do analysis of that NP account. They look at the lacunas which the borrower is having. They try to plug that. So there is a higher rate of interest which they charge. But there is no bar per se as far as funding to such accounts are concerned. Within the bank, the account will. Yeah. Only thing is that as a part of restructuring process, for 1 year you can keep it as standard. And then it turns into PA or NPA based on actual performance. It is based on cust ID. Yeah. Typically in all the banks, once you mark an account as NPA, the cust ID is marked as NPA. So all loans in cust ID will turn into NPA. Only the exceptions to this rule is LCBD, as I said. So in LCBD, they have a facility wherein LCBD gets excluded as a product code. Second is as far as advance against FD is concerned, that gets marked as NPA, but there is no provision which is done. Because in custody, they cannot pick it up. But otherwise, it's custody level, not at the branch level. No, for every bank, there will be one custody. It will be bank wise. So once you mark an account as NPA in a particular bank, all credit facilities related to that custody will get marked.
Within that bank?
Within that bank.
Okay.
And NPA classification is per bank. So I can have an account as a borrower in one bank, my account might be NPA, in other bank it can be a PA.
Should it be mentioned in the appraisal process, sir? You taught appraisal process.
Appraisal note, it has to be
person
mentioned.
applies to us for a loan.
Yeah.
He has been an NPA with some other bank.
Yeah.
So
that has to be mentioned.
He is supposed to bring it to the knowledge.
Yeah. But the challenge is that as an auditor, we will never come to know that. Unless he discloses.
But he is, by justice, he is disqualified.
He is not disqualified. There are banks which are giving loans to NP accounts.
There are policies.
There are policies. And see, nowadays the easiest way is to go through CIBIL report.
Okay.
So in a few minutes you come to know that whether the account is PA or NPA. Since CIBIL also, the bank has internal process wherein CIBIL report can be kept aside if the borrower gives a justification and documentary evidence for that. Typically, there might be old credit card dues. So if he gives a no dues certificate, the bank can correspond with that particular bank, confirm it and go ahead. Because many times the CIBIL record takes time to update their records.
Sir, you said about associated concerns.
Yeah.
Suppose X is an individual borrower. He has caused the NPA with respect to that. He has a partnership firm X, Y and Co where he is a partner.
Yeah.
Whether that loan facilities enjoyed by X, Y, and Co is also classified as NPA, sir,
No, it is borrower wise, not group wise.
not group wise.
Unless there is a diversion of fund, unless there is a fraudulent activity which is carried out between these two entities, otherwise not.
Thank you, sir.
Otherwise it is custody wise, that is borrower wise, not group wise. Then the last point was about compliance with RBI and internal exposure norms. We'll go through internal exposure norms in little more detail at a little later date. But always, keep one thing in mind, that wherever a loan is sanctioned, that has to be within the ambit of what is permitted to the bank. So you need to keep a note of whether the bank is taking into consideration the exposure norms, whether the bank is correctly classifying the loan under specific category or not, because based on that only the exposure norms for a pan bank level will get considered. So the master data checking is not your job, but whichever loans which you are looking at or whichever loans you have verified, it's better that you check that master data once. It's not that entire bank's master data or entire branch master data you are supposed to check, but suppose you have checked say 20 accounts, you are duty bound to check that whether the classification, exposure, value of security, all the master data details are correctly fed by the bank or not. Then the next point about which is a kind of part of appraisal process is pre-disbursement inspection, wherein the sanctioning authority or the designated sanctioning authority is supposed to visit the borrower's premises, carry out a pre-disbursement inspection and keep that report on record as a part of bank's documentation. Then whenever the disbursement happens, typical flow of disbursement is that first the documentation will get get covered up. So every bank will have different sets of document which has to be executed for a different type of products, loan products which the bank is having. Also check that the documentation which the borrower is executing, whether it is matching with what is there in the sanction letter. So the terms and conditions of sanction letter and that which are incorporated in the documentation should gel with each other. ROC charge creation is the one which you need to look at it. If you have a doubt or if you are testing say top 5 account in the branch, you can always take an inspection on your own also. It hardly costs anything to take a ROC inspection, but it's always a prudent practice to do that. End use is required to be ensured by the bank, and as an auditor you can inquire with them as to what is their internal control mechanism to ensure that end use is monitored by them. It is not your duty to ensure the end use of a particular borrower. It is the bank's duty. So you need to cross check with them as to what is their internal control related to verification.
ಅದು ಇದು ಕಳ್ಸಿದ್ರಿ ಇದು ಇಲ್ಲ ಇನ್ನೂ ಬಂದಿಲ್ಲ ಸರ್ ಅದು ನನ್ನ ಕಡೆ ಇಲ್ಲ ಆಕ್ಚುಲಿ ಯಾವ್ದು ಇದ್ರದ್ದು ಯಾಕೆ ಮಾತಾಡ್ತಿದ್ರು ಸ್ಕೋದು ಸ್ಕ್ಯಾನ್ ಮಾಡಿ ಕಳಿಸ್ತೀನಿ
Print of the week. 1920 ಇದೆ 2021 ಕೊಟ್ಟಿದ್ದಾರೆ ಜೀತಿದೆ ಅಪ್ಡೇಟ್ ಅದೇ ಎರಡನ್ನು ಕೊಡಿ
ಜೀತದ್ದು ಒಂದು ನಾನು ಅಪ್ಡೇಟೆಡ್ ಅಂದ್ರೆ ಇದು ಕಳಿಸ್ತೀನಿ
ಅಲ್ಲ ಅದು ನಾನು ಅವರೇ ಕನ್ಫ್ಯೂಸ್ ನಾನು ಮಾಡ್ತೀನಿ ನೀವು ಏನ್ ಗೊತ್ತಾ ನಮ್ಗೆ ಒರಿಜಿನಲ್ ಕೊಟ್ಟು ಒಂದು ಸ್ಕ್ಯಾನ್ ಕಳಿಸ್ಬಿಡಿ ಈಗ ಓಕೆ ಜಿನ್ಸನ್ಗೆ ನಾನು ಇಲ್ಲಿ ಮಂಡೇ ಬರ್ತೀನಿ ಮಂಡೇ ಟ್ಯೂಸ್ಡೇ ಬಂದು ಕರೆಕ್ಟ್ ಅಪ್ಡೇಟ್ ಮಾಡಿ ಕೊಟ್ಬಿಟ್ಟು ಜೀತಿದ್ದು ಮತ್ತೆ ಬ್ಯಾಂಕ್ ಬೆಸ್ಕೋದು.
Inspection report has to be there on the record. Also verify that the inspection charges which are charged to the borrower and what is the date of your inspection report. It might happen that all the inspection reports are created at the year end, but there are no inspection charges which are levied in that particular bank account. So if it is consistently observed that inspection reports are there but inspection charges are not there, you can very well conclude that the real inspection hasn't taken place. So there has to be a circumstantial evidence related to inspection. Or you might also come across a scenario wherein standard inspection charges are levied every quarter. There are certain banks which mandate quarterly inspection. So they have included that in their CBS system only. It is automated. So every quarter there is an inspection charge. So this is something which is which usually will not happen, because it's not only inspection charges which the bankers will levy to the borrower's account. They will also levy the conveyance or some kind of out-of-pocket expenses that you will see only once in a year. And then you can conclude that actually the inspection charges which are levied on a quarterly basis, the real inspection is only once in a year. No, if that is the case, they need to have that quarterly reports also on record. I will tell you one step ahead, because I have never seen any
fixed amount they fix, including the traveling and
that's right. So then in entire year there should not be any OP which should be debited to that particular account. So their practice should speak actually, because some cases what happens is they don't charge. What you say is right. That's what is written. But if they really incur something that's out of pocket expenses, they have a habit to debit that particular account.
If any out of pocket expenses is debited in addition to the inspection charges, the borrower will fight.
That is right. So if they are not charging any out of pocket expenses, only thing which you need to see is, if you are having quarterly charges which are debited to the account, there should be 4 reports available on the record. Because you cannot simply charge inspection charges without conducting an inspection. That was the point actually.
Yeah, evidence should be there.
Evidence should be there. Secondly, if you want to go a little step ahead, or if you have sufficient manpower available with you for audit, or maybe having sufficient articles available with you, just ask them to compare with attendance register. So half of the things will get revealed. Why I'm saying that is that why I gave a reference of articles is that, see, they need to learn as to how to check that whether a particular not transaction but inspection is really carried out or not. Once you give them a hint, they will perform more than what you are expecting from them. So just give them or show them the ways to verify certain things. Attendance report is the best way to verify so many things. You can very well use that as a kind of a tactical tool.
Sir, for some of the advances, the government is giving subsidy or grant, sir.
Yeah.
So the government is an indirect participant in the business. Whether for such advances also inspection reports and charges are compulsory or not?
That will depend upon the scheme, central government scheme, that is first thing. And secondly, based on your credit policy which the bank is having. Bank will have internal policy about that. You have to go by that. Typically, government scheme doesn't stipulate anything about that. They only stipulate about what is the eligibility. So banker has to demonstrate before you how they have verified that.
So even government assisted loans are also subjected to inspection.
Of course. I will give you a simple example about certification, since you are on government related part. Typically the incentive schemes, where education loan or any subvention scheme for that matter. See, education loans, all of us are doing certification of that. At every yearly intervals, whenever we are doing statutory audit, we give that certification. How many of us really pull out the file related to maybe 3 years back and check on a sample basis as to whatever they are right now giving us, which is purely in the Excel form, there is nothing beyond that. We need to go a step ahead actually. Whenever we are doing certification, we need to verify the files on a random basis. I'm not saying that on 100% basis. But suppose education loan, there is some benefit, government scheme benefit, which the bank is passing on to that particular borrower, maybe in the year 21-22. Loan might be related to 18-19. As an auditor, I have every right to call for that file. Practically, I will never go through hundreds of files, but I can just pull up 1 or 2 files and verify that. So whatever was expected from the borrower side, I have every right to inspect and verify that whether those documents are there or not, and the bank is taking due care for that or not. That is very much within the ambit. But the moment if you ask any file, typically education loan or any similar government scheme file, the bankers might deny you. But you have a tool in your hand that you can simply deny from doing certification for that. The bankers will make all files available to you.
Sir, with regard to housing loans, they are produced and photograph and all, sir.
Yeah.
So that is taken as
That is
evidence.
sufficient. See, we have to believe the bankers. I am
Yes.
not saying that we should disbelieve, but they should give a evidence which is consistent in all the files. It is not specifically for one
Sir,
file.
with regard to education loans,
Yeah.
to my knowledge, to the extent of my little knowledge, most of the loans are turning to be NPA, sir. Education loans.
It
What
depends.
type of follow-up action can be taken by the banks?
Nothing, sir. See, it's similar to Mudra loan. It depends upon the ultimately intention of the borrower. See, the intention of government is to incentivize a particular sector or particular type of loan. Like say Mudra loan, there is a ease of taking the loan. But you must have seen that even in Mudra loan, certain branches have a high level of NPAs and certain branches don't have high level of NPA because they have applied their mind while giving a Mudra loan, that whether he is eligible, whether he is requiring that kind of loan or not. If that is done, there shouldn't be any issue. And Mudra loan per se, I will tell you frankly, many people are not even aware that they can avail Mudra loan. I will give you a simple example. How many of us have availed Mudra loan? No one. All of us are eligible. The loan is available at a cheaper rate. Now the other interest rates are going down, so that's a different story. But if you look at say 3 years or 4 years bank, no one will give you an unsecured loan at 9%. But we don't avail that. So that's the issue with all government schemes. So it depends upon the implementing agency as to how they are implementing that.
Sir, in LFAR, they are asking a question, sir.
Yeah.
Whether the branch is taking follow-up action with regard to advances.
Yeah.
What we have to verify, sir? Actually?
See, the typically in banks, depending upon which bank you are doing, they have a structure wherein zonal or regional office will instruct that branch to carry out certain follow-up action. You need to only see that whether they have done that or not.
But what is the difference between follow-up action and recovery?
The follow-up action will be visiting their borrower's place, initiating the action against the borrower, recovering the assets, auctioning the assets. It depends upon the nature of loan and type of action which they are asking for.
Follow-up has got no definition.
There is no definition.
But there is a question. Follow-up is done or not?
Follow-up is typically is that they need to.
So whether can we give an affirmative or negative answer for that, sir? Suppose we want to give a yes.
No. Simple thing is that pick up randomly certain NP accounts in under different products.
Okay, sir.
Ask the bank what kind of follow-up action you have taken.
Okay, sir.
They have to prove before you that they have taken the follow-up action. You don't have to worry about that. If they fail to produce anything before you, you can say that there was no documentary evidence which was produced.
No documentary evidence.
See, even if they are calling up certain borrower, ideally they should write down or jot down somewhere that on so and so date I have called up this particular fellow, and kind of a small minutes, 2-3 line minutes they can write. They have to prove before you that they are they are doing a follow-up action. So it's bank's responsibility, not our. Then as far as monitoring is concerned, there are multiple ways to monitor advance. I can just extend for 5 minutes so that I will finish off this slide and we can break for lunch. As far as monitoring is concerned, one is that there are various exception reports which are generated from the CBS system. So firstly, you need to be aware about which exception reports are generated. Ask the bank also, that is the branch manager also, that which are the exception reports which is routinely going through. Now the standard answer might be that the head office or maybe the zonal office typically prescribes that certain reports are to be seen by the branch manager on a daily basis, some are weekly, some are monthly. There are some banks which have a system wherein the printouts of those exception report is also taken and the branch manager signs it off and keeps it in a file. Just pull out any report and ask the branch manager as to how you use this exception report, because the exception report has to be effectively used. It is not supposed to be signed and kept in the cupboard in the file. That is not the purpose of that. So you can very well comment upon how the exception reports are used. Secondly, as far as stock audits are concerned, many a times the stock audit gets ignored because there are many a times there are valid discrepancies are there which a stock auditor might be highlighting since long, right from non-availability of DP, or maybe the borrower might not have cooperated with the particular stock auditor. All kind of discrepancies will be there. Make use of that. I will draw your attention to one more thing. Maybe few of you are already doing that. There is a RBI circular about early warning signal. Have you gone through that? That early warning signal has specific points which are related to stock audit. Just to give you an example, if the stock audit is not conducted or if the stock audit is continuously postponed, the borrower is not cooperative with the stock auditor, it is a kind of early warning signal. It also includes certain parameters which earlier few of you were asking the queries about March statement and audited financial statement deviations. Even those have been included in the early warning signals. And fortunately, the revised LFAR, which is there, it has a mention of early warning signal system also. So the bank has to demonstrate before you as to what kind of internal control mechanism they are having to identify the parameters of early warning signals. There are almost 30 plus early warning signals which have been listed down. So the bank has to show you as to how they are taking care of all those 30 indicators at the branch level. So ask them pinpointed questions. If they say that we don't have such system, just include that in LFAR. The regional office will come running after you by showing you how the early warning signals are implemented in the bank. Only thing is that ensure that you are taking proper MR, saying that they don't have any system of early warning signal, and then only incorporate that point. Then as far as branch inspections are concerned, we already discussed that depending upon what kind of internal mechanism they are having, quarterly, half yearly or annual inspections, that will be carried out. Renewal is something which is a kind of a tricky issue in certain cases. So let me just touch upon that and then we'll break for lunch. So as far as renewals are concerned, if you look at the IRAC norms, what is expected is full-fledged renewals are expected. Ad hoc, short reviews, technical reviews are of no use. Technical reviews and short reviews are limited only to the extent that the bank is agreeing to continue with that limit. So they are not calling back that particular advance. So maybe suppose financial statements are not there or certain property documents are not there, then the bankers are supposed to do a short review or a technical review. And once that period gets over, the actual renewal is required to be done. So if the actual renewal is not done within the prescribed time period, the account will turn into NPA, and the counting of number of days will be right from the expiry of actual expiry, not from the expiry of short-term reviews. So whenever the renewal process is carried out, just ask the branch to give you a system generated report of all the renewals which are done during the year. So it will also give you the the borrower accounts wherein the due date is changed. So many a times the due date is changed for say 3 months because of short reviews, and system will not come to know that whether it is a short review or whether it is a regular renewal, because if the branch manager chooses a regular renewal option, it will presume that it is a regular renewal for 3 months. So your entire IRAC system, which is supposed to be automated, will go wrong. So pay attention to what is meant by renewal and whether the bank is doing a short review or a renewal. It has to be a renewal process and not a short review process. Just last one point, since we are talking about IRAC norms and sir also touched upon the automation of that. If you come across any bank which claims that IRAC system is automated, just ask them one question as to how you are capturing agricultural loan related data. Because it has short term, short duration crop and long duration crop. So unless every year the branch manager, if he feeds the entire details in that system, that too along with SLBC related criteria, for each crop there is a SLBC defined number of months criteria, then only IRAC norms can be automated. So if the bank is claiming that, just ask this simple question to them, and usually your argument will not go beyond that particular point. So I just thought that I will just add it up. So we'll take a break for lunch, and we'll continue after the lunch.
Dear members, let's all break for lunch now and assemble here in 30 minutes by 2:15 p.m. Thank you. Bon appetit.
I presume that I should ask you a couple of questions in between. Keep you away. So just so going further, there are certain checkpoints which I just jotted down based on the discrepancies which I observed while I was doing the audit. First part, we already discussed about checking of master data. Now, when I say master data checking in CBS, I want to limit that only to the extent of advances which an auditor will cover during his audit process, not the entire master data which you are supposed to verify. Second thing is that accounts wherein the renewals are pending, typically you will get the ready-made list out of CBS system itself as exception report. You can go through that and then verify as to whether a particular account needs to be marked as NPA or not. Short and technical reviews, ask the bank categorically or ask the branch categorically as to how many accounts have been short reviewed or technically reviewed during the year. So you need to have an entire list of such accounts wherein short review was carried out. Once you get the entire list, from the branch itself, it will be an easy process for you to identify such accounts wherein 90 days or 180 days are already getting expired at that point of time. Same logic applies to ad hoc and TODs. So verify the system of granting ad hocs and how the master data is changed. Typically in most of the CBS, there is a separate line item or separate field which asks you to enter the details related to ad hoc and TODs. So the actual limit remains constant, and ad hoc or TOD limits are separately set out in that. One more thing is that always keep an eye on possibility of evergreening of account which might happen, and evergreening need not be happening through the same custody. There can be a group account wherein the loan might get sanctioned, and by using those funds, the normal account, that is the main account, might get regularized. Just to give an example, suppose we have a corporate account wherein say term loan installments are say overdue for more than two installments are overdue. So there is a possibility that the director of the company might offer his own property against which the bank might fund to that particular individual at an individual level itself. Those funds gets diverted into company by way of introduction of capital or by way of introduction of unsecured loans from directors, and the account gets regularized. So wherever you see that SMA1, SMA2 accounts are getting regularized, that is always a possibility exists as to what is the source of fund. So always pay attention to that particular point, and such kind of evergreening need not be restricted only to your branch. There can be a loan sanctioned in some other branch and the funds can be brought in over there. There is another possibility that the funds might be belonging to loan which is available from other than the bank wherein you are doing the audit. So always pay attention to the source of funds through which the regularization of the account has taken place. And another way to verify that is, all the banks are having a system wherein the CRILC reporting is there for advances wherein exposure is above 5 crores. So in those cases, if you just happen to run through the CRILC reporting which is done by the branch, you will get the ready-made list of SMA0, SMA1 and SMA2 accounts, and then you can do an analysis. Maybe just take a CRILC reporting on which is a monthly a monthly basis reporting. Analyze the accounts as to which are the accounts which have suddenly come from SMA2 to SMA0 or got out of SMA status itself, and then pay little more attention to such accounts. Another thing is that many a times there are waivers which are given by the branches to fulfill certain conditions which are part of terms and condition of a sanction letter. Now always remember one point: wherever a waiver is given, the waiver has to be given by an authority higher than the authority which has given the sanction letter, because there is something which is a kind of a deviation. Typically branches can never give any waiver. I will give a simple example and a most common example of waivers. Many a times you will observe that commitment charges are waived. Waiver of commitment charges is never within the power of the branch in charge. You need to obtain a sanction from an authority which is higher than the branch in charge. So suppose a branch is headed by DGM, even if he is a DGM, he cannot give that waiver because he is a branch in charge. He has to go as a level above him, obtain such waivers in writing, and then only such waivers are given. So granting of waiver is not the right which is available with the branch in charge. That is the right which is available for someone who is above that branch in charge, irrespective of what is the hierarchy of that branch in charge. Another thing is that many times there are discretionary powers which are used by the branch manager or the branch in charge. So wherever such discretionary powers are used, firstly,
that delegation of discretionary power has to be there with that particular person. Then only that is supposed to be used. For example, suppose there is a discretion given for overdrawing, up to the extent of say 10% of limit. So that discretion is limited only to allowance of overdrawing and not related to TOD. TOD is different, and using a discretion of say overdrawing or something is a different thing. And that too, it has to be within the delegated powers which are given to the person who is using that particular discretionary powers. Another point is that the discretionary powers are required to be used diligently. It is not, they are not supposed to be used to accommodate a particular borrower. So you cannot favor a particular borrower. So whenever a discretionary power is used, it has to be backed by reasoning for that as to why the discretionary power was used or why a waiver is given. So the documentation is a critical one, wherein the reasons for those discretionary power usage is required to be maintained. Another thing is about, there might be instances wherein the field officer might have overruled the sanction terms and conditions. I will just give you an example. Suppose the sanction terms provides, or rather I will just draw an example which he rightly gave about the March end stock statement submission. So nowadays, you might have observed that many a times 27th March, 28th March dated stock statement is submitted. So you first ask that particular person as to what is your bank's policy about date of stock statement. They need to have a policy. If the policy is not there, ask them to give that in writing by saying that there is no policy of the bank which stipulates that what should be the date of the stock statement. The moment he has to write down whatever you are asking for, 99% he will say that there is a mistake which the borrower has done. He will never say that I have done a mistake or I have suggested that, but it serves your purpose. So wherever you feel that there is a kind of vague answer which is given by the branch manager, always insist that answer to be penned down and signed by him. Same logic applies to you also. You cannot make a vague statement. You need to put that in writing, or rather, I will put it in a different way. See, you need to say something only when you are sure that you can put that in writing and sign it off. Otherwise, you shouldn't qualify any report, or you shouldn't give a positive comment also on anything. So you should be very certain about that. Same logic applies to the branch side also, that the branch in charge should give that in writing, that we have a policy that March statements are permitted other than for 31st March. Let him put that in writing. The moment he puts that in writing, you can simply qualify your main report also, you can qualify your LFAR, you can qualify everything and anything. Just take that in writing. Or in case if he is disagreeing with that, send an email to him, kind of a negative confirmatory letter, by saying that during the discussion you have said that there is no bar on borrower submitting a stock statement which is not dated as of the last date of the month. Let him respond to that. If he doesn't respond to that, put that verbatimly in your LFAR. Your purpose will get served and the practices will stop at particular point. Only thing is that we as an auditor need to take that stand. Another thing is that many a times you might have observed that the sanction, that is the appraisal note, sanction note and sanction letter, these three things should be in sync with each other. Many a times the sanction note which is there, which is the internal document of the bank, there are certain things or certain conditions which are stipulated in sanction note or appraisal note, whatever is the nomenclature is used. Same thing should get reproduced in the sanction letter also. So suppose there are certain conditions which are stipulated in sanction note, say 10 conditions are there, your sanction letter should also be having those 10 conditions. The issuing authority cannot dilute by just picking up only 8 conditions out of that and 2 conditions are just not picked up in sanction letter. This is something which shouldn't happen. So wherever you are going through the file, always pay attention to the appraisal note, sanction note and sanction letter and see that all are in sync with each other or not. Another possibility is that there is a possibility that the account might get restructured in a very diligent manner. In the sense, right now, last year we had all COVID circulars. Always keep one thing in mind. When the COVID circulars were issued, the COVID circulars were confined only to those accounts which are affected by COVID pandemic. They were not supposed to be used by a person who is not getting affected by COVID-19 pandemic. So if you see that the entire income flow, the account operation, the turnover of that particular borrower, everything is fine, it's unlikely that he is eligible for those concessions. So it's not that just because COVID-19 pandemic was there, each and every person is eligible for that. That is not the scenario. So verify that whether he is getting affected by the pandemic or not, and to prove whether a person is affected by pandemic or not, First is first, that is the responsibility of the borrower, and second is the responsibility of the banker. You are there as an auditor only to verify whether the sufficient documentary evidence is available there or not. You don't have to really conclude as to whether someone is affected by COVID or not. Getting hospitalization is not getting affected by COVID-19 pandemic. Affecting your business is the one, or affecting your income source is the one wherein you need to avail those concessions. Another thing is that for agricultural loans as well as these pandemic related concession certificates, they are conditional. So for example, as far as agricultural loans are concerned, restructuring is possible only when there is a natural calamity which exists in that particular district. So it is not the case that all agricultural loans are always eligible for restructuring. That is not the case. So everything is conditional. So make it a point to see that firstly whether a loan is restructured or not. So if there is any concession which is passed on to the borrower other than market conditions, in the sense other than market competitive conditions, everything is restructured. So change in rate of interest, change in limit, change in installment like ballooning, all these things will get into a mode wherein restructuring happens. Let me tell you one last thing about restructuring. In COVID-19 first circular, that 6 months moratorium period was granted for EMI repayment. So it was a kind of a holiday or a cooling period, I should say. Now the RBI had stipulated that when a borrower avails that particular holiday, EMI payment holiday from March till August, the loan tenure will also get extended, but that was only for that equivalent period. It was not for beyond 6 months. So for every such loan, the EMI was supposed to change. If you observe that EMI has been kept constant, in all likely with all likely reasons, it might have fallen into a 7th month or 8th month. That will amount to restructuring. That is not eligible for COVID concessions. That will you need to downgrade such accounts wherein it has got extended beyond 6 months. Then another one is about the adverse comments which you might observe. So go through the concurrent audit reports, go through credit audit reports, go through stock audit reports which are available. One more point is that in the MRL which you are taking, take a MRL of all the reports which were made available to you at the branch with a disclaimer that there is no other report which was not shown to you. So if you are having say stock audit reports of say 50 borrower, put it that as a MRL, that 50 borrower stock audit reports were available. So if there is 51st or 52nd report available, you are absolved. You are not held responsible related to those accounts. As far as credit rating is concerned, typically internal and external credit rating, both modes are possible depending upon the bank's practice. And typically based on credit rating, the rate of interest might undergo change. So just pay attention to the credit policy of the bank, and based on that, how the credit rating and interest rates are linked. As far as financial projections are concerned, we already discussed about the realisticness of financial projections. So pay attention to that. Classification of advances, especially about priority, non-priority, weaker section. So all these are the instances wherein as an auditor, you need to pick up certain accounts on a random basis, verify as to how the bank is categorizing that in master data, because based on master data, the classification will happen at the branch level. And based on branch classification, the bank's targets will be met. So the vital point is that at the branch level, you need to verify that central auditor practically cannot do anything about all these priority sector targets, exposure norm targets, targets in the sense restrictions. So these are confined to the branch, and as a branch auditor, indirectly you are responsible for those classifications. As far as loan documentation are concerned, many banks are having a system of having legal weighting for all accounts which are crossing a particular threshold limit. So understand the bank's internal policy as to when the legal weighting is made mandatory. There is one more thing related to legal weighting. There is a RBI circular which talks about legal audit or legal weighting of the borrower accounts which are having exposures above 5 crores. So on an annual basis, there is a legal audit which is required to be conducted for all those borrower accounts. So just go through that, go through such borrower accounts as to whether the annual legal audit for those accounts has been conducted or not. Another thing is that as far as original document verification is concerned, you can pick up certain accounts related to earlier years just to verify that what is the internal control mechanism of the bank related to preservation of original documents related to borrower accounts. If you happen to go to, there are many banks wherein CPC cells are there, that is central processing cells are there. You can pick up any account at random basis. You need not confine yourself only to the current year's loan. As an auditor, you have every right to audit any account. So even if the loan is sanctioned say 10 years back and it is a housing loan, but if you feel that you want to check that particular account, you have every right to do that, even though it is not mandated. See, what is mandated in LFAR is what is the minimum required checking which should be done by you. It doesn't talk about what, beyond that, whether you should go or not. It is silent on that. So it's up to you. It's your discretion to, pick up such cases. Another thing is that wherever you are going for audit, verify the applicable stamp duty related to that, because each state has different laws about stamp duty applicability. So whichever branch is allocated to you, you need to have a basic understanding about the stamp duty applicable to bank related document. In case if you happen not to have those things handy, you can always talk with any CA in that particular state who is known to you and take a basic understanding about what kind of stamp duty is there. Just to give an example, suppose today I get a branch which is in Tamil Nadu. I may not be even able to understand that what is the percentage of stamp duty is applicable for banking related documents, because I might be aware only about Maharashtra related documents. So take a professional help related to that, just to have a basic understanding as to what is the stamp duty rate, because stamp duty rates vary a lot across the state. Now almost all states are reaching at the peak level, so there is a competition in that. But earlier there used to be a huge difference, especially in Delhi. The stamp duty was almost minimal. Now that is not the scenario, but it might happen that your your back of mind, whatever rates you are having are related to your state. You may not get the branch which is in your home state. You can get branches across India. So just pay attention to that. Another is that CIBIL report. As far as CIBIL report is concerned, verify whether the latest CIBIL report was obtained by the branch or not, and how they are acted upon that. All banks are having a policy about having a threshold of CIBIL points, and if it is below threshold, they need to give a justification for that. CIBIL report applies also for Mudra loans. So there is no exemption for Mudra loans to give loan to anyone and everyone. There is a restriction on that, and all banks are supposed to follow that diligently. Another interesting report which is there on file is CR, that is confidential report, which is obtained from other bankers. Why I'm saying interesting is that I have never seen any bank talking about adversely about any borrower account, even if they are having say a current account wherein there are hardly any transactions are there. But there is a standard remark that performance of account satisfactory. So now what is meant by satisfactory is something which one can never understand. But that's a banking practice, I should say. We cannot criticize as to how the CR should be issued. Another thing is that there is NAYAC committee recommendation about working capital finance as to how the bank should assess that. Now what NAYAC committee says is that first thing is that the assessment will be based on projected turnover. So whatever is projected turnover, your projections are there, that is the starting point. Working capital requirements are required to be 25% of your projected turnover. And there is a 2080 formula about how much bank should finance and how much should be borne by the promoter or the company or the borrower, I should say. So indirectly what happens is after we apply 2080% formula for the 25% portion, indirectly it means that whatever is your projected turnover is there, 20% is the finance which the bank can give. So 2080 you need to apply to 25%. So if you apply to that 25%, 20% becomes your CC limit. So that is a NAYAC committee recommendation how the banks are interpreting. It is only to arrive at what is maximum permissible bank finance. So it is only an indicator. There is no hard and fast rule that the bank should stick to this particular formula. It's only a guiding principle. And second thing is that once you arrive at this limit or possible limit, I should say, after that DP concept applies. After that NAYAC committee is not of any use, because then you need to have a drawing power. This is only on projection. DP is on actual. So the account will get operated on actual figures and not on projected figures which are given a year back. So that's how the DP will come into play. A couple of slides I have just included may not really apply to branch per se, but these are important from branch point of view, because basically if the master data at branch is not correct, all these ratios related to exposure norms which are typically looked at head office level will go haywire, because your branch data should be pure, otherwise your consolidation will never be exact. So we'll quickly cover couple of exposure norms. So firstly, for single borrower and group borrower, there is a exposure norm prescribed. Single borrower exposure is 15% of capital funds and group borrower is 40% of capital funds. And there is an additional leverage which is given for infrastructure related companies, wherein for single borrower, you can have 15 plus 5, that is 20% exposure. And for group, it is 40 plus 10, that is you can go to the extent of 50%, but that is confined only for infrastructure related exposures. As far as group borrower definition is concerned, RBI doesn't define what is meant by group borrowers. So we as a CA, we need to interpret that in normal accounting parlance. So typically what we interpret is whoever are related parties or the parties wherein there is a common management or there is a you can say a pursuance which you can or you can influence a management decision. So all those parties should be combined and called as group borrowers. But RBI per se doesn't have any directive which defines what is meant by group group exposures. As far as PSUs are concerned, RBI has given a guidance that only single borrower exposures limit should be applicable, because group borrower naturally will not apply. Group is central government company, so everything will get covered under that. So their group borrower concept is not applicable. As far as LCBD is concerned, we already talked about that. Wherever the LCBD is the advance which is given, so the LC issuing bank will be the one on whom the bank will be taking an exposure. And in case if you are discounting LC which is issued by your own bank, then only the exposure will be on the borrower, because you cannot have exposure on your own. So suppose you are doing audit of SBI branch, and there is a customer who has brought SBI issued LC for discounting, then the exposure will be on borrower, because SBI will not have exposure on SBI. But suppose the borrower has got Bank of India LC, so the exposure will not be on borrower, but the exposure will be on Bank of India. As far as certain exceptions are concerned related to these exposure norms, these are logical exceptions, that wherever the account is under rehabilitation, it might happen that it might exceed the single borrower exposure norms because of accumulated interest component related to that, or related to certain additional facilities which are sanctioned for that nursing case. For food credit, it is exempted because food credit is directly given to the central government under the food credit program. So those are not covered under single and group borrower concept. Central government guaranteed accounts are out of this coverage. Advance against own FD are out of all exposure norms. Just to give an example, suppose a bank is having a limit on say CRE exposures, internal limit. But if you are given a loan against FD, that loan will not get counted for that CRE exposure also. The reason being all exposure limits or all exposure prudential norms are related to the risk taking ability of that particular bank. So whenever a bank is sanctioning any limit against FD, there is no risk of realization which is involved. So it is out of all exposure norms. Another thing is that exposure to NABARD, that is again excluded. Typically in NABARD, only point which we need to see is that the exposure will not, that exemption is not related to unrated non-SLR securities which are issued by NABARD. So there the exposure norms will apply. As far as sectorial limits are concerned, it is the bank's internal prerogative to decide that what should be the sectorial limit. CRE or real estate exposure also, bank has to define its own limits for their own consumption. Leasing and hire purchase, the exposure of each type should not exceed 10% of total advance. So for leasing 10%, hire purchase 10% and factoring 10%. So individually that cannot exceed the 10% cap. As far as real estate exposure is concerned, RBI has only given a kind of a caution guideline as to how the bank should define the limit. But RBI is silent about any percentages. So like say 15% was single exposure limit which is given. For real estate, there is no such exposure limit which RBI has defined. So every bank will define as to what should be the exposure limit, and they need to confine to that. As a branch auditor, what is your duty is you should be able to identify that whether a particular exposure is exposure to real estate or it is exposure to something else. I will give a couple of examples wherein controversies occur. Exposure for say building up of a hotel premises. Exposure wherein housing complexes are built for onward selling the as a dwelling unit. Another is infrastructure projects wherein at times there are challenges which are faced about bifurcating that into real estate and infrastructure projects, especially when the project relates to the government aided grants. Then as far as capital market exposures are concerned, capital market exposures are defined wherein a bank takes either a direct exposure or takes an indirect exposure. Direct exposure is confined only to treasury department. So at branch level, it will not be there. Indirect exposures are very much there at branch level. So wherever the primary security is in the form of equity shares or equity oriented mutual funds or convertible debentures and bonds, all such exposures will be counted as exposure to capital market. Another example is that any type of loan which is given to the share broker, that is the person or the entity which is having its main business of share broking. So irrespective of type of loan which is given, that gets counted as exposure to capital market, except one example, that is advance against FD, that is out of all purviews. As far as collateral securities are concerned, collateral securities will not get factored in to count this exposure. You need to concentrate only on primary security. So it might happen that 70% of primary security is not related to equity shares, 30% might be related to equity shares. So in that case, only the 30% component should be factored in to calculate the capital market exposure limits. Capital market exposure limits are substantially on a higher side. Just to give an example, direct exposure caps are 20% of net worth, and indirect exposure, that is exposure to share market in an indirect way, that limits are 40% of net worth. So practically no bank is really nearing to that that level. But at the branch level, if you happen to come across any loan which is given to a person who is having main business of share broking or is related to share market, that should be factored in as an exposure to capital market. This is just to show certain examples. So I will just give you a definition of net worth just to run through that. When I'm saying 20% of net worth or 40% of net worth at the head office level, how it is calculated, same plain logic is applicable. So whichever funds are belonging to the owner of that particular bank, that is net worth. So your equity shares, premium on equity shares, then free reserves, profit and loss credit balance, netted by profit and loss debit balance, revaluation reserves you have to exclude because those are not realized. So till the time they are not realized, those will get excluded. Now only challenge as far as net worth is concerned is related to the revaluation reserves, because what happens is every year your revaluation reserves will gradually get converted into general reserves whenever you provide for depreciation. So to that extent your net worth will gradually start rising. The logic behind that is your P&L account is already hit by that higher level depreciation, that is a depreciation which is charged on revalued amount. So it gets compensated when you are calculating the net worth. So the balance portion of revaluation reserve will only get excluded, otherwise everything will get included. Those of you who are well versed with Basel III norms, just to put it in simple terms, tier 1 capital will typically denote net worth. Tier 2, everything will get excluded. So subordinate bonds will get excluded. Tier 1 is confined only to equity shares, and additional tier 1 is related to non-cumulative preferential, non-cumulative perpetual preferentials. So only to that extent net worth will get restricted. All other instrument will get excluded as far as calculation of net worth is concerned. Calculation of exposure, how to calculate that? This is just a simple chart to give you an example of calculating that. As far as term loans are concerned, you need to consider that in case of term loans, if the entire amount is fully drawn, then you should go by balance outstanding. If that is not the case, then any undrawn portion has to be factored in when you are calculating the exposure norms. So for example, if you have sanction limit of 10 crore, against that 10 crore, only 8 crores are drawn by that particular borrower, and borrower is still eligible to draw that additional 2 crore portion, which is undrawn portion. So that will get factored in whenever you are calculating the exposure. So wherever in RBI norms you come across the word exposure, exposure means whatever is drawable has to be added up to the balance outstanding. So any exposure norms or any criteria in LFAR for selection of loans, whenever the word exposure gets used, it is different than outstanding balance, and you need to go based on that exposure word. Financing of equities, in fact RBI hasn't come out with any new circular, so I have just continued with the old one. Practically now physical securities are not supposed to exist, and practically banks are not supposed to lend against the security of which are in physical form. But since the circular is 2015 dated and till now the master direction or master circular are yet to come, the limits are 10 lakh for physical and 20 lakh for the securities which are held in demat form. As yeah. Which is going again above this.
Share certificates held in physical form.
Yeah.
Not in demat form.
Yeah.
So the bankers at any cost cannot sell.
Yeah.
So no security. Security value is 0.
See, actually, if the bank has already created a charge on those shares if they are having a documentary evidence to prove that, you can take it as secured. Because the bank is having a right over that.
Even though it is not in demat form.
That is fine. See, demat form is required only for to trade in the shares.
So you suppose the borrower is not traceable.
Yeah.
How can the bankers will sell the?
That's why if the charge is created, the bank would have charge created in the register with the register of those shares.
Okay, okay.
So then bank can enforce it.
Yeah.
Bank doesn't require that borrower to be present.
Yeah, yeah, yeah. Correct. Sir.
Otherwise, what you say is right.
Yeah.
If the charge is not created, it is unsecured. Having physical shares with you is of no use. Because that is something which is practically only a piece of paper. Unless you have a confirmatory letter from register. That charge is created in his record. And then you need to take a yearly confirmation. Because you cannot prove it also that if it is vacated or not. But typically nowadays physical securities are no more there, except the cases which are legacy issues, as you said, that the borrower is not available. Now in that case, what really happens is, if the borrower is not traceable, you need to ask the bank as to what kind of action the bank has taken. Because you cannot continue just like that for few years. So you need to take action and you need to start a recovery process. The moment you start a recovery process, if you sell off those shares, whatever balance is available, that becomes unsecured. Because security might have got already exhausted. Then as far as financing of employees, ESOPs are concerned, many times the banks are getting into ESOP funding. So in that case, the cap is again 20 lakhs as upper cap. But within that, bank can fund only to the extent of 90%. 100% funding is not expected as far as ESOP loans are concerned. Advances against shares to other borrowers, that is other than individuals, it is prohibited to NBFCs. It cannot be accepted as a primary security. So wherever you come across loan against shares, it has to be only confined to the individual. Non-individual loan against shares are prohibited. It can be taken as collateral, but not as a primary security. So you cannot have exposure taken related to shares other than for individual borrowers. Other than individual, when I say it includes HUF also. So loan to HUF against shares held by HUF will be prohibited. That is not permitted. Bridge loans are permitted, even though they are not that common, but there is a condition that bridge loans are permitted only for 1 year. So whenever there is an expected equity flow is there for any company, and the bank is just funding for bridging that particular gap, that is possible, but it is confined only to 1 year. Beyond 1 year, one is not supposed to go. One more thing is that whenever such bridge loans are given, the bridge loans are supposed to be given whenever there is a visibility is there as far as future equity cash inflows are concerned. So suppose there is no visibility, the loan cannot be even called as a bridge loan. Then it is purely funding against your promoter's contribution, which is categorically prohibited by RBI. Then advance against shares to stockbrokers, we already talked about that. Another is, as far as margin money is concerned, there has to be a uniform margin of 50% so that the market fluctuations are taken care of. So wherever the margin is falling below 50%, the limit is required to be adjusted. And then you need to see the effect about the NPA norms related to that as to whether it is falling under continuously overdrawn or not. Guarantees which are issued in the capital market operations are concerned, RBI stipulated that at least 25% has to be cash margin. And that is again linked with that 50% margin concept which you can give. So suppose you have a shares worth rupees say 1 crore. So against that 50% of that, so 50 lakh can be only considered as a security. Another thing is that 25% cash margin has to be there, so that 50 lakhs will be confined to 25% component. So bank cannot go beyond that. Bank cannot dilute that 50% portion of margin for funded as well as non-funded based facilities. Advance against units of mutual funds are concerned. Again, the same logic for equity oriented mutual funds. One more important factor is that if the mutual fund is under lock-in period, the banks are not supposed to fund against that. Suppose you have a close-ended scheme wherein there is a structured instrument which is maturing exactly after say 5 years and it is not tradable in between that. So in such cases, funding against that is prohibited. You can fund only in those cases wherein the lock-in period is over and the banks are able to encash that particular portion, because otherwise practically enforceability of security will depend upon completion of certain period. So banks are not supposed to enter into that lock-in period. Once the lock-in period gets over, bank can give finance against that. End use, only one restriction is there, that if you avail finance against mutual fund, you are not supposed to again invest in mutual fund. So otherwise there will be a cyclical kind of scenario which will happen in the mutual fund industry. So to avoid that, that is the only restriction, additional restriction which has been put in for end use. Advance against own shares is prohibited. So if you are doing say a branch of say State Bank of India, SBI cannot fund against security of SBI shares. So that is categorically prohibited. So you need to be little careful about what kind of equity shares are offered as a security by the borrower. Loan to directors of the bank is prohibited. I'm sure that all of you are aware about that. Even though practically none of us, I suppose, really verifies at the branch level as to whether any director's loan account exists or not. A simple test actually, again, as I will say, that you can always search your custody. Just take annual report of the bank, have it cross-check once. Why I'm saying that also, I will tell you the reason. Suppose by remotest possibility, say 0.01% possibility, some director has availed a loan, from your branch. As an auditor, you might get, might be held responsible for that. So whatever 8, 10 directors or 15 directors are there in a bank, just ask one of your assistant to just go through the custodies of the bank and just satisfy yourself that there is no loan which is given to the director, or at least if not that, at least make it a point to include in your MRL that there is no loan to directors which was extended by the branch. So at least to some extent you are shielded, not fully, but at least partially. Only restriction which RBI has put in is that industries which are producing or consuming the ODS, so to that industries loans are prohibited. Usually bankers don't get into that. In case if you happen to come across any appraisal note which mentions that, you need to be alert about that.
There are doubts, sir.
Yeah.
With regard to the personal loan,
Yeah.
which is obtained by the employees of the branch,
Yeah.
do we have to obtain the end use of the loan? Because the very name personal loan signifies that can be used for any purpose or something else. Do we have to verify the end use?
Yeah. See, first thing is that whenever a staff loan is given, they are governed by wage revision agreements. So you can ask for that as to how he becomes eligible for that. Typically in that agreement, the end use are specified. So I will give one simple example. Suppose there is a scheme wherein for repairs of house repairs, there is a lump sum amount of say 5 lakhs which is given. Means I'm giving a typical case because that's where the issue really arises, or say consumer durable loans. You need to satisfy yourself that the end use is insured by that branch. Now how you can ensure that is, suppose it is a vehicle loan, comparatively it is easier. But if it is a consumer durable loan and you come across say a estimate of some furniture and fixtures which are made at a house, you can very well raise an objection and give a suggestion that end use is not monitored.
In one of the branches I
Yeah.
audited,
Yeah.
one managerial level employee obtained 7 or 8 loans.
Okay.
My subconscious mind told that he is doing a business in competition with the bank.
Yeah.
Yes, sir. Yes, sir. That's, I cannot tell it directly. So what type of audit procedure and reporting should be advised in that perspective, sir?
See, whenever you are having a doubt about something, there are two possibilities. One is that you are able to prove it. Then I don't have to tell you what should be done, because that is a simple thing. Whenever you are not sure about that, you can mention that in LFAR by saying that this is an odd practice which I have observed, and leave it there itself.
Limit.
You don't have to conclude.
But the employee says that I am taking the loans only up to the limits of my sanction.
No, that's why I'm saying don't conclude. So he cannot object. You can say that I have just written a factual thing that you have taken loan 8 times.
Yes, sir.
I'm not commenting anything on that. I'm only bringing that to the attention of central auditor. See, that clause in LFAR is drafted in such a way that you can write anything in that.
Okay, sir.
Only thing is that you should be hinting towards something. You cannot say that, he has availed twice. It won't make any sense. But suppose, as you said, 7 or 8 times, it makes sense.
At a time, he has got 7 or 8 loans.
Exactly. So wherever you, you come across any odd practices, wherein you are suspicious, but you are not able to conclude that, because it's not that easy to conclude all those things. And you are there as a statutory auditor. You are not there as an investigator.
Yes, sir.
So you can just highlight that and just leave it there. Don't conclude that, because the moment you conclude that, the branch will challenge you on that. So don't conclude, and then you can tell him that I have just written a factual thing. You don't have to do anything else. But I will just add one point since you are talking about that. Again, I won't name a bank. There is a big urban cooperative banks wherein recently RBI had asked the bank to remove CEO because of that. He was availing the loans and giving it further as a kind of commercial loans to the bank's borrower itself. RBI was able to do that because RBI has access to multiple banks. So they were able to find it out at branch or at bank. It was not possible actually. But RBI is very stringent on on all such practices. So if you happen to come across that, it's worth mentioning that in your report. Yeah.
Sir, as Mr. Govindarajan said, if the personal loan, the purpose is not specifically mentioned,
Yeah.
we don't have any role to verify the end use. That's what I feel, sir.
Okay, I got it. Yeah.
Yeah.
See, personal loan cannot have a use as personal. That cannot be the personal. No.
Without any specific purpose in the sanction letter,
Yeah.
if it is sanctioned as a personal
Yeah.
loan,
Yeah.
the borrower can buy vessels for his house or dress materials for his wife. We are not concerned.
No, that is right, sir. But whenever the application
Because it is within the norms of the bank as personal loan granted to
I
employees.
agree. Only thing is that then the application letter should specify that.
Yeah, application and also the sanction
Application
letter.
form has to specify that, and bank has to take due precaution that they are within the permitted end use. Like he should not use that for horse trading or other things which are prohibited. So bank has to just ensure. In fact, what the bank can do is that bank should have a residual clause wherein it should say that it should not be used for so and so purpose. That is the best way to address that. Because personal use can be anything: hospitalization, travel, self-consumption, consumer loan, anything can be there. Only thing is that criteria should be specific.
Personal loan is for personal use.
That is true.
Yeah.
Except prohibited category.
I don't think so. The banker did not mention about the prohibited.
No, then banker has to
in
prove
the sanction
that.
letter.
No. Then I'm saying that then the banker has to prove before you as to how they are taking care of end use of those funds. They have to tell you that.
So in that case, a banker also has to verify the end use of the.
Bankers are bound to do that. In fact, each credit policy mentions that.
If the loan is not sanctioned for any specific purpose, how can the bankers verify whether it has been used for the purpose?
Yeah, I will answer your query. See, if you look at any credit policy, it talks about mentioning the purpose. So it is always for purpose the bank sanctions the loan. You will not come across a credit policy which says that sanction a loan without a reason or without end use. Bank cannot say that. So bank has to give loan for maybe for applied purpose, even that is sufficient. But there has to be some nexus which the bank has to build. And secondly, going a little further, forget about personal loan or any loan. Bank should have an internal control mechanism to cross check that the purpose for which the bank has decided to sanction a loan is met. Some kind of internal mechanism. How is bankers look out? They have to prove before us as to how they are taking care of that. So if they are saying personal, let them demonstrate before us as to how they look at it. Look at that, that particular aspect. If the practice is just to disburse the loan entirely in saving account and then cash is withdrawn, there is something which is lacking at the bank's end, which you can point out as a factual thing. That's why I said that at certain points you need to just give an observatory comment. You don't have to conclude that. You can say that there is a lacuna in internal control mechanism, or bank has not defined to verify the end use. Let the bank accept it. It's very difficult for bank to accept that they are not verifying end use even for personal loan. They will never accept that in writing. Verbally they will say. If you ask them to put it in writing, they will hesitate in that. Yeah. Yeah.
Bank. There is a 20 employee bank. All assume for their personal loan.
Yeah.
That way misuse of funds will be there. It will be a risk to also country.
That is true. No, actually, see, ultimately, banking and giving loan is bankers' business. So we are not objecting on that. Only thing that they need to have, or they need to rather demonstrate us as to whether due care is taken by them or not. How is their lookout, not our lookout? They have to prove before us that there are certain precautions which they are taking. That is sufficient. If you find it satisfactory, it's fine. As far as gold loans are concerned, I will just quickly cover that. So the maximum amount exposure defined in RBI circular is of 2 lakh. Maximum tenure is defined as 12 months. Bullet repayment, they are given that interest has to be levied on monthly basis, but due can be at the time of maturity. But all these things should be factored in sanction letter. So if the sanction letter says that interest should be paid monthly, it will become monthly due. If the sanction letter says that bullet payment will include interest also for that entire year, so interest will get charged to the account, but it will not be due. So no question of applying NPA norms related to that, because it is not due. It is accrued but not due. LTV ratio has to be always maintained. If the LTV ratio is tweaked, then the account can be classified as NPA. Another thing is that as far as these gold loans are concerned, many banks are in habitual practice wherein after every 1 year, again the gold valuation will be done. The same gold will be used as a security, and the proceeds will be used to close earlier loan. This is a clear-cut case of evergreening. Take an objection on that. You can mark such accounts as NPA also, because ultimately one has to first close the account, free up the security, and then only new loan can be sanctioned. It's not like, in anticipation of closing the loan, I cannot use the same security. It amounts to double finance. Even if for half an hour also, if it happens, it's a double finance, which is not permitted. So this can very well end up in possibility of evergreening. Next few slides I will not cover, because I just want to touch upon, can I take 15 minutes roughly? Yeah. So I'll touch upon LFAR clauses which are related to advances. Fair practice code for lenders I have just given for reference purpose. Make use of that, because this is mandatory for almost all banks. Almost all nationalized banks have agreed to fair practice code, which they never follow. I will give a simple example, and I will start the next presentation. The simple example is that for any loan, the banker who has adopted fair practice code for lenders is supposed to give a copy of loan agreement. Have you come across a nationalized bank which gives a copy of loan agreement? But just compare that with commercial banks. Commercial banks, that is private sector commercial banks, they are having a practice wherein the filled up loan agreements are shared with the borrower. They send it by email. It's not that physical copy has to be submitted. You can always send it to registered email ID. So just make use of this fair practice code. Go through that. That fair practice code is really interesting to go through, especially as a non-banker, because there are so many things which which you will come across which are never followed by the banks, but which exist, and which bankers say that they are sticking to fair practice code. So I just thought that I will just make a cursory glance about fair practice code. So I will just start with the second presentation, which is related to LFAR, and a few points we have already covered. We'll just go clause by clause related to advances part, and I have written certain checkpoints against each clauses, so that it can become a kind of a handy tool for you for checking those things. Let me just start with that presentation.
Here is an announcement. In the interest of time, we'll have the tea served in the hall to all the members, requesting all the members to remain seated as we continue to the next technical session after the session by CA Dhananjay. Thank you.
I will skip the initial slides. What I intend to cover is part 5 of LFAR, which talks about advances. Other part of LFAR I am not covering. I am covering only related to advances part. As you're aware, revised format was issued in last year. So 2021 was the first year of revised LFAR. I will just spend 2 minutes on this revised LFAR. Last year when new LFAR format was introduced, many of you who were doing bank audits must have observed that there was a sea change in LFAR. Let me just give you a little background about that before I start off with the presentation. I'll just go to the further slides so we can start that quickly. The new LFAR which was issued by RBI, there are a lot of efforts which were put in by CA Institute also behind that. And even though it appears to be little exhaustive one, I will tell you the purpose of that. In the earlier LFAR, you must have noticed that there were stereotype questions were there. Half of them were redundant actually. They were not really relevant, and many times the auditors were giving answers which were epic one also, like whether the printouts of books of accounts have been kept or not. No? This question was really redundant. So many questions were there. When the revised LFAR was suggested from institute side to RBI, there were two things which were kept in mind. First thing is that to make ourselves accountable also for certain things, we need to take certain responsibilities as an auditor. So that's where, if you have noticed actually, whichever advances we have verified, there is a list of those advances which we need to specify in that. It limits our risk also, that we are covering only these accounts, and we make it point clear that suppose 10 accounts have been verified by us. As an auditor, I will write down 10 account numbers over there, and my all observations are related to those 10 accounts. So it's more of combination of revising the LFAR in terms of new age bankers, and also in terms of certain risk and responsibilities which we as auditor are supposed to take up. So at times you will feel that it is more akin to concurrent audit in certain cases. The reality is that it's more of a checklist which is available for advances. So think from that angle, that once you cover up all these advances, portfolio, just ask yourself that is there any question which is there in LFAR which you would have otherwise skipped while verifying an advance file, and then the answer will be easier. Because I know that in last year there was a lot of resistance also, there was a lot of criticism also about LFAR, but this is more in the form of checklist, wherein as an auditor you will not skip a single point. So once you check a borrower file based on this checklist kind of approach, there are very remote chances that you will skip on a particular aspect, or something might get out of your attention. Now we'll start with general guidelines, or the basic things which RBI has put in. There is a change, as you are aware, as compared to the earlier year. The mandatory advances limit has been increased to 10 crores as compared to earlier 2 crores. That is first change. Second thing is that the large advances are defined over here, which talks about outstanding amount. So it starts with outstanding amount. Nowhere there is a limit which is mentioned. Second thing is that outstanding amount is in excess of 10% of outstanding aggregate fund and non-fund based limit. So that is the second change. So you need to factor in outstanding fund as well as out of balance sheet, that is non-fund based limits also, and then calculate that 10% limit. So it ensures to cover the scenarios wherein funded limits are on a lower side and non-funded limits are on a very much on a higher side. There are instances of corporates which typically prefer to use non-fund based limits and keep their funded limits on a lower side. So what will happen, the benefit out of that also, I will just spell it out. Just take a case, something similar to PNB, or wherein non-fund based limits were there. So in earlier norm, those limits were never covered when we were, picking up the accounts on a sample basis. Now here what happens is, if you have a borrower who is having say 100 crores of fund based limit and 100 crores of non-fund based limit, but fund based limits are used only to the extent of 1 crore and non-fund are used to the extent of 90 crores. But if you look at the bank from banking perspective, even 90 crores non-funded limits are of same importance, because tomorrow it might happen that those non-fund based limit will devolve on the bank and it will get converted into a funded limit. So such risk prone areas are also getting covered. So that is the logic behind as to why non-funded limits are covered. Even though our fees are not based on non-fund based limits, sample size is based on fund based as well as non-fund based limits. Now for all accounts which are above threshold limits, that is this 10 crore or 10% of outstanding of fund and non-fund based limit, you need to scrutinize all the accounts. So the specific details are required to be seen and commented upon, as compared to others wherein you can restrict yourself only to go through the account operation or on a peripheral area. So that is the distinction between these two. So one is mandatory, second one is optional. So comparatively, the checking extent or checking level can be reduced to all such accounts which are falling below this threshold. Now, as far as list of accounts which are examined are concerned, it starts with giving a list of accounts which you have examined. So all accounts which are above threshold, those are required to be mandatorily over here. Along with that, if you happen to cross check any other accounts, maybe smaller accounts, those accounts will also get added up over here. Now from documentation point of view, or from compliance of standards on auditing point of view, what I will suggest is, once you have above threshold, that each and every advanced product is also getting covered by you or not. So suppose you are having 10 or 15 various products of advances which is sanctioned by that particular branch, and for these mandatory accounts which are required to be covered by you, only say 3 out of those 10 products are getting covered. So for rest of the 7 products, at least pick up 1 or 2 samples for each product, so that your coverage or sampling will be complete and fulfilled from SS point of view and from your documentation point of view. Another thing is that there is a important factor which we need to ensure, that whichever accounts you have verified, your working paper files should speak about that. You cannot say that I have written down say 10 10 borrower accounts in my LFAR. It means that I have verified 10 accounts. That is not the case. Your working paper file should speak about that. It should have adequate notes or whatever written document or some notes which you might have prepared for every account, which should form part of your documentation file. Then as far as credit appraisal part is concerned, we'll start with that portion. In credit appraisal part also, there is a specific question which which it starts with. In your opinion, has the branch generally complied with the procedures and instructions of the controlling authorities regarding loan application, preparation of proposal, enhancement of limit, and which will also include the adequate appraisal documents which should be there. Now the last line which I have intentionally underlined is that what RBI is expecting you to reply is, what is in your opinion are the major shortcomings in credit appraisal, which we talked about in pre-lunch session. So whichever shortcomings are there in appraisal process, that you can very well mention about. Again, to distinguish, the credit call which is taken by the bank, that is something which you cannot question. But if there is any discrepancy in appraisal, discrepancy which you have observed in deviation from credit policy, that is something which you can very well mention and that you can very well factor in. Another thing is that the early mortality cases are required to be reported by you. So you need to verify that for all NPA accounts, are there any accounts which have turned into SMA or NPA category within 12 months from the date of sanction or not?
One doubt, sir.
Yeah.
In documentation, you were mentioning that, say, for example, I have selected 10 accounts in a loan portfolio.
Yeah.
So for all the 10 accounts, I have written the basic profile, name of the borrower, account number, limit sanctioned, balance outstanding, etc. And I record only the adverse remarks in the notes. So out of 9 accounts, out of 10 accounts I have selected, 9 are quite okay. No, okay. I will write just only one, no remarks, no remarks.
Okay.
The 10th account, there are some adverse points. I will write that, whether it is enough.
From my point of view, that is not sufficient. It's better to have a kind of a short checklist available as your documentation part, that you have checked certain things. A basic checklist, single pager checklist is also sufficient. I will just give you an example of checklist. In fact, what I will do is I will just share with the branch the checklist which I am using for certain loans, just to give a kind of a guidance. It will change from bank to bank. I will just give you an example, a simple example. For example, if I am checking say vehicle loan, so what checklist I will prepare? I will mention that whether pro forma is available, final invoice is available, agreement is available, and I will just tick it. So it's a single page checklist which anyone should be able to use. So the advantage in that is, see, ultimately what happens is, let's look at from peer review point of view. The signing partner cannot say that I have checked everything. It becomes little odd. So there has to be someone else other than you also who should be involved in the audit process. Yeah, exactly. Precisely. So the other person is supposed to fill up that checklist. You will review it just by putting a maybe an initial, and that suffice the purpose. I'm not saying 4 pages, 5 pages checklist. I'm just saying single page checklist, basic indicators, what you will check. So for example, you will check that whether it is completely filled up or not. So you will have 2 columns, partially filled up, completely filled up. You will just tick it. So it indicates that you are aware about what should be checked, and that is checked by you. you need to prove that you have checked. Just to put it in other way around. So that's the reason why I'm saying that just prepare a single pager checklist. Nothing like, you know, too complex or nothing, easy to fill up. So any of our, you know, assistants should be able to fill it up. If we give file to him, the basic thing should be checked by him. So I'll just try to share 3-4 formats, and you can also share, you know, the further worked out format with me. I'll just share that. I will send to branch ID and they can circulate it. Quick mortality we already discussed. Then as far as applicable rate of interest is concerned, again over here, the accounts which are selected by you, you need to you know, confine your comments related to only that. You are not supposed to check all rate of interest in your bank, in your branch. Another thing is that as far as periodical reviews are concerned, many banks are having a system wherein the MCLR based you know, floating rates are there. So verify the periodicity and how the rates are getting changed in CBS. Inquire with the branch manager as to whether the branch manager is having the power to change the rate of interest or not. Ideally, he shouldn't be having any power. It should get centrally changed. So once MCLR is changed, all loan accounts interest rate should ideally be undergoing a change. Then the frequent renewals and short reviews, in case if you observed in any account, that you can mention over here. So pay attention to the IRAC norms related to short reviews. Then the sixth question is whether correct and valid credit rating is available or not, and whether the borrower has obtained the credit rating from the approved agencies. Now here what you need to verify is, you need to verify that the credit rating, if it is obtained from external agencies, it is not more than 1 year old. So it has to be a latest one, and this gets linked with your Basel III calculations. Because in Basel III, the exposures which are above 5 crores, there the risk conversion factor is based on the rating of the borrower accounts. So the accounts which are above 5 crores, the credit rating is mandatory, and it should not be old more than 1 year. Then in case of accounts examined by you, you need to comment about credit facilities which have been sanctioned beyond the delegated powers. So the delegated power matrix has to be available with you. You need to verify that with the accounts which are picked up as a sample case for your verification. Then any advances which have been disbursed without complying the conditions of sanction letter. This is something I presume that all of us have been doing since long. Just ensure that partially filled up documentation and other things should be also forming part of non-fulfillment of terms and conditions, because unless documentation is completed, the disbursement of you know, loan is not supposed to be factored in. The next one is, did the bank provide loans to the companies for buyback of shares or securities? Now this is something which is prohibited. This is permitted only when you know, there is an acquisition process which is carried out by some other entity. So suppose there is a change of management is concerned. So just to give an example, like Tata's acquired Air India. So for that funding is possible. It's not exactly buyback per se. So it's acquisition for change of management. So in those cases it is permitted, otherwise it is not permitted. As far as documentation is concerned, in case if any issues related to adequacy of stamp duties are seen, you can report that. Partially filled up documents is another example to report over here. Non-registration of charges, so you should verify the SIRC registration, whether it is affected or not. One more agency is there, NESL. I don't know whether you heard about that or not. NESL is a separate registry wherein the charge creation related documents and loan related documents are also registered. It's a third party entity. You can say kind of ROC, not exactly ROC per se. It's a parallel agency. NESL registration is not mandatory, but it is recommended. So many banks are pushing the borrowers to go to NESL. As an auditor, you can always go to NESL website and take an extract of the charge which is created and the documents which are submitted over there. But NESL's SIRC, ROC, all are running parallelly actually. So the purpose is same. Purpose is to ensure that there is a registry which should be available to verify that you know, where the charge is created and which securities have been taken. Then as far as lien marking is concerned, there is a specific comment you need to make wherever the securities are taken in the form of FDs of the bank. You need to verify both lien marking on physical FDRs also and also in the system. go through the system or go through the process which the bank follows wherever the FDs are falling due and whenever they are renewed. Because many a times at the time of renewal of FDs, the lien marking is invoked, and again the lien marking is put in after a certain gap. So just ensure that there is no dilution of lien marking which is possible in the system. Review monitoring and supervision, certain checkpoints I have mentioned. Many of you might have been already come across that. All the banks are having a system when its AODs are obtained, that is acknowledgement of debt. So there are many banks which obtain AODs in bunches. So 5 AODs are taken and they are kept blank. So every year the branch manager will just put in the date and he will produce before the auditor that AOD is obtained. Just inquire or just keep your eyes open to see that whether blank AODs are there or not. If blank AODs are there, that is a practice which you should comment upon. Then another couple of points are related to drawing power, which we already discussed about the issues which are related to drawing power. Another thing is that as far as the DP checking is concerned, whichever accounts drawing power checking you have done based on stock statements which are submitted, make it a habit to document that in your record, that which are the accounts wherein DP was checked by you. So suppose tomorrow something goes wrong, your working paper will speak for you, that an account wherein maybe some fraud has occurred, but if it was not there in your sample data, naturally you will not be held responsible. So always make it a point that whichever account you have checked, for whatever reasons or for whichever question is there, it's better that you make a documented document out of that and ensure that it forms part of your working paper file. Stock audit reports we already saw. Compliance with regulations. As far as the non-corporate entities are concerned, I will just touch base upon one point. RBI has stipulated that any non-corporate entity wherein any exposure is taken above 10 lakhs, the audited financial statements were mandatory. Subsequently, RBI had issued a circular wherein that 10 lakh limit can be tweaked by the bank. So the bank has to decide that what should be the limit for non-corporate borrowers above which audited financial statements are mandatory. So every bank has a different kind of limit which is set out. If there is no limit set out by the bank, then 10 lakh limit still prevails. So you need to check with the bank as to what is the limit, which threshold limit which the bank has defined. Diligence report, as I said, RBI has specified due diligence report. It is a diligence report. You can just search on RBI website where the circular of diligence report is there. It's a 5-page circular, out of which 3 pages are questionnaire, wherein the auditor has to answer those questions and give it as a diligence report. Inspection register, we already talked about that. Substantial deterioration in value is a question which is pointed towards straightaway classification norms, the one which we discussed, wherein deterioration is beyond 50% or security value is less than 10% of ledger outstanding. So the question is hinting towards IRAC norms. Insurance policies, we already discussed about the adequacy of insurance policy. Then one more point which I will like to point out over here is, as far as overdrawing is concerned, also pay attention to possibility of intraday overdrawings, wherein the accommodation is done. Now there, as an auditor, you don't have to really work on which are the intraday overdrawings which are done. You ask the bank how you are monitoring. Yeah, so we as an auditor cannot really find out that easily. So the question which we need to ask the bank is, as far as intraday overdrawings are concerned, whether you are having any exception reports which is generated from the system or not. If the report is not there, give a negative comment over there, that since there is no exception report available, we are not able to comment upon intraday overdrawings. So disclaim whatever you are not able to verify, because intraday overdrawing is quite common across the banking sector for various purposes. Let's not get into those purposes. In fact, intraday overdrawing is also subjected to bank interest, which banks are supposed to charge to the borrower, because in a way they are lending to that particular borrower. But it's difficult to capture unless CBS is really equipped with that kind of parameterization. Red flag account, there is a question. So red flag account is the one wherein there is a suspicion of fraud, and there is a mention of early warning signal which is also made. Go through the RBI circular of early warning signal and verify whether the bank is having the system incorporated related to that. Then there is a comment on top 5 standard large advances. Now here the standard word is important. In many, in many branches, the top 5 accounts, out of that maybe 2 or 3 might be NP accounts. So those are not required to be factored in. You are supposed to comment only on top 5 standard accounts. Naturally, we should not include NP accounts. And leasing and finance activities, these are rarely there at the branch level. So that's why I haven't really covered that, because typically these activities are confined to a particular branch only, a specialized branch. Otherwise, leasing and finance activities are not undertaken by the branches. As far as reporting summary is concerned, I have just given a couple of points for your reference purpose. I will just pick up 1 or 2 before I conclude, because I know that I have overrun on time. So I'll just conclude that on 1 note. See, wherever you are writing any report, make it a point that you are writing in a very crisp language. There is no ambiguous language which is used. Don't leave decision to the central auditor's level by saying that you are observed n number of things, and then concluding remark should not be the something like central auditor should take a suitable stand. I've seen couple of reports wherein branch auditors write, it's a entire history of the borrower is written, n number of lacunas are written, and at the end it is written that as far as classification is concerned, central auditor should take a suitable view. There cannot be any suitable view by the central auditor. You are the branch auditor. Whatever views should be taken by you. And wherever the branch manager is not ready to give you anything in writing, make it a habit to email him minutes of the meeting, whatever discussion which you are holding with the branch manager, and whichever strange things which is projecting before you, just put that in writing. Send him an email by saying that this is the minutes of discussion. So if there is anything to be changed, he can respond back to you. So it becomes kind of a confirmatory thing if he doesn't respond back to you. So make your documentation perfect. Every time, written document doesn't mean that a physical document, and it need not be countersigned by the branch manager. Now emails are there, and now all of us have been used to doing virtual audits also without visiting the branches. So make use of those habits, which all of us have adopted in last 2 years, and make the branch audit carried out in a professional way. One last thing, so the earlier one was second last thing. See, wherever you feel that a particular branch audit is not doable by you, don't accept that assignment. Just don't accept the bank assignment just because you have got it because of empanelment. If you don't have sufficient manpower, if you feel that you don't have sufficient banking knowledge, it's better to refrain from that. I'll tell you the reason why I'm saying that. See, for example, earlier GST audits were there. Now, suppose as a CA, I'm not practicing in GST. I shouldn't be doing GST audit just because client is after me to sign off the audit. Same logic applies to the banking industry. Banking industry is becoming dynamic day by day. Don't take chances by just going along with empanelment. If you're really keen on bank audits, make it a habit that throughout the year you have your internal program to train yourself, including your staff, and ensure that you're visiting RBI website at least once in a month. So that is a basic indicator as to whether you should do the bank audit or not. You should be aware about which are the latest guidelines which are issued by RBI, at least which are affecting your normal plain branches. For example, IRAC norms, till now there are 2 clarificatory circulars which have got issued. So if you are knowing only master direction or master circular, it's of no use, because there are subsequent 2 circulars also which have got issued. And last but not the least, try to read bank audit guidance note at least in next year. So once you go through the bank audit guidance note, you will you can just jot down the points which might have skipped your attention in the last year. There is always a second year available. So make it a habit to improvise on year basis to ensure that bank audits do continue with CAs and they don't get discontinued. I don't want to sound pessimistic, but at the same time, remember one thing, that there has to be some kind of a value addition from our end also. So try to have some kind of a value addition whenever you are doing bank audit. So thanks to all of you, and sorry for extending my session beyond the allocated time. Thank you very much. Thanks.
Thank you very much for sharing your wisdom on verification of advances and summarizing the nuances of various aspects of bank audit, sir. Any questions from members are welcome now. Members connected virtually are welcome to unmute and present their questions.
regarding the non-fund based limits.
Yeah.
How we can verify whether the branch has recorded correctly?
Sir, nowadays LCBGs are issued electronically. So there is a serial number also which is given. So once we generate a CBS based LCBG register, we will come to know about LCBG. So non-fund based limits are very much
If the
available in
limits
CBS.
are not used, how you will verify?
The sanction limits will be there in the CBS system which are fed.
Non-fund based also. will be
Yeah.
there.
Earlier, the CBS systems were not really comfortable with non-fund based limits. But now CBS, all CBS systems are having that factored into their main core system itself. Earlier, as you said, they were bifurcated. So they were not forming part of CBS system, but now they have already incorporated that. So even interchangeability of limit and everything is also automated now. So even that part can be checked in CBS.
One more question, sir.
Yes, sir.
So apart from signing the balance sheet and other certificates,
Yeah.
we are also asked to sign the Gilani committee report and the Ghosh committee report.
Yeah.
What is the use of it, sir? For the past several years, more than 2 decades,
Yeah.
I am signing. Every time I am given just 2 or 3 minutes time.
Okay. I will
Not able.
answer.
I will just read and satisfy myself whether it is correctly. I will mark yes or no. I won't allow the manager to mark.
Exactly. So that's
I mark myself.
that's perfect.
That is
sir.
the main point I do.
I
I will read and understand the question
Correct.
and answer.
Yeah.
But apart from that, I am not able to verify anything, sir.
Uh,
But every year I am signing.
I will tell you
What is the quantum of responsibility placed on the auditor?
see, ideally, the moment IFC has got introduced in IFCOR has got introduced in banking, gradually the relevance will no more be there. Earlier, the relevance was more about the internal control system of the bank. Unfortunately, I will tell you what has happened. The practice which you are following is rarely followed by the CS. That is reading and answering. So your certain questions must be giving an adverse remark, if I am not wrong. Not all, but wherever you are observing that certain practices are not followed. Unfortunately, most of the auditors don't do that. And I will tell you how it is taken care at the head office level. The moment if you say anything which is adverse in any report, whether it is Ghosh Jilani or any certification, the central auditor cannot dodge that. He has to get deeper into that. And the bank has to satisfy him that he should not qualify the main Ghosh Jilani report. RBI reviews that very seriously. So the issue is that most of the auditors give this report to be filled up by the branch manager and they only sign it. So naturally he will always have all affirmative answers. That's where the issue is.
One easy example can be given that whether there is a sufficient rotation among the staff
Yeah.
every 6 months. Everyone says yes, but the cashier is placed there for the
Yeah.
past 2 years
I will
in the same seat.
Sir, I will share one thing again off the record. Even though we are live, still I will say that I am saying this off the record. 3 years back, there was an attempt which was made from institute side. I was also part of that to review Ghosh Jilani questions and to verify whether anything is irrelevant or not. Frankly speaking, we couldn't find an answer as to why the question should be dropped. Sorry. So only it was limiting to that extent. So it's why I'm saying that is on a broader basis. As I said, the rotation of duty, still it is valid. See, I will tell you what happens at institute level whenever such suggestions are required to be given. We need to justify that. Yeah. Yeah. So I will tell you the reason. No, sir, I will tell you the reason. Ghosh Jilani committee reports are based on fraudulent activities which happened in banking sector. So they are basically to plug that. If the bankers are not complying with that, it's their risk. So we should say no, there is no rotation. So suppose something goes wrong, bankers are responsible, not auditors. That is the whole purpose actually. Answer should be correctly given after reading the question. And I will just, since many of you are here, just try to go through those questions here and try to check that which question can be dropped. It's very difficult to drop any question. Except, as microfilming or other, that is fine, wherein there is a redundant technology, it's fine. But otherwise, it's not that easy. Yeah. It's very difficult to drop any question. Take my word, you can also try, means all of you can try. If you are able to justify dropping of any question, I will again try to escalate this matter. I was frankly speaking not able to drop a single question out of that, major question I should say. That's where the issue is. We need to justify as to why it should be dropped.
Sir, I have a question.
Yeah.
In continuation of that,
Yeah.
you said with the introduction of IFC, this will probably become redundant.
Yeah.
But even now we are required to report on IFC. What are the controls operating at the branch?
That's right.
The branch has no idea what is IFC, what is control, other than probably locking in. They have no idea what is a control.
Yeah.
Currently, we are saying the control set is defined by the head office. XYZ is what is operating at the local level. I'm literally disclaiming it. I'm not saying in the affirmative, I'm disclaiming it. Is that the only way to go about, or?
I will tell you how the public sector banks are going about that. Public sector banks, the central auditor picks up certain branches for testing the data. Only those auditors have been given a detailed questionnaire. Other auditors, no. So that's why I'm saying that it depends upon your central auditor how he is looking at that. There are many banks wherein central auditors are picking up certain branches at random, like small, medium, large, and corporate finance like that. So they give a separate questionnaire for specific questions. So it's a testing of IFC. So because see in IFC you don't have to test the entire data. If the controls are not there, you disclaim it. Then it is the responsibility of the central auditor. But bankers are finding it little difficult to adopt as to what is meant by IFC. The issue is starting from that point. No, they say that we have all control. So that's the reality. Should we conclude? So thanks a lot to all of you for patiently hearing me. Thank you very much.
Now we invite CA Jayaseelan to honor CA Dhananjay Gokhale with a memento.